First, I'd like to introduce David Stoyer. He's the Chief Operating Officer for San Diego County, and he's also the former CFO there. So here he is.
Thank you, Philip. Well, good morning and welcome. I've been doing the Economic Roundtable since 2004, and I can't believe over the years how much this has grown as far as attendees. But it's my pleasure to kick off the 35th Annual County of San Diego Economic Roundtable, and I want to thank you all for attending here today. The Economic Roundtable is the longest-running, free, local economic forecasting event in this region, and has grown into a forum for experts to share their thoughts on the upcoming year, what the upcoming year will bring. And believe me, 2019 will be no exception. Here today are economists, industry experts, and business leaders from various sectors. We look forward to hearing from our panelists and what they think 2019 will hold for not only our national economy, but our local economy as well. We look forward to gaining additional insight in the impact of housing, homelessness, the military, and diversity and inclusion. These topics are always important to residents, businesses, nonprofit organizations, and of course, to governments. I would also like to thank our partners in planning and hosting today's event and for their efforts to support the region as we look forward to 2019. First, the San Diego Workforce Partnership. Second, the San Diego Union-Tribune. And finally, the globally ranked University of San Diego School of Business that is committed to San Diego's future economic growth and innovation, and also our host today. So I hope you all enjoy the 35th Annual San Diego Economic Roundtable, and at this time it's my pleasure to introduce Jaime Alonso Gomez, the Dean of the USD School of Business Administration, for a few words. Jaime?
We are in times of volatility, uncertainty, complexity, and ambiguity. This is what we call VUCA times: volatility, uncertainty, complexity, and ambiguity. Recent examples: the dynamism of the stock market, Brexit in the UK and Europe, political and economic dynamics in Brazil and Argentina, and 27 additional days of situations that we all know about here at home. Indeed, times of tremendous opportunity and challenge. In interacting with this environment, we in the School of Business see the future in three ways. One is the future comes to me and captures me, takes me. Nokia, Xerox, BlackBerry, Kodak. We can continue with some additional names. Number two, we see the future and adapt to it. Darwin, we match environmental conditions. But here in the School of Business, we choose number three. We create the future. And we actually try to do this via education with purpose. Let us here in San Diego, for instance, education with purpose means some of these examples I'm going to share with you. The Tijuana-San Diego area is a $230 billion economy, and we want this economy to grow and develop. We want to be co-producers of sustainable and responsible new wealth. 5 ways by which we are trying to be co-producers of this new wealth. We work with the military community, which is one of the main themes today. And in particular, we help and work with those people who are in the mid-40s and that are migrating from military life to civic life. And we work with them via education, and we produce basically 4 avenues for them to consider. Via education, they become entrepreneurs, and they start their own business. They become corporate executives, they become consultants, or they become coaches and mentors. So we work with the military community. We also emphasize innovation and entrepreneurship in our MBA and other graduate courses and undergraduate courses. And last year, 37% of our MBA graduates started their own business. In addition to that, we joined forces with the Small Business Administration of the United States, and now we have the BRINC, an innovation-driven small business development center. And now we are helping and serving 200 companies in becoming more competitive domestically and internationally. Last December, we were ranked #1 in San Diego, #1 business accelerator and incubator. More than 200 companies being served in that area. Also, the School of Business and the School of Peace together, we create the Center for Peace and Commerce that fosters the creation of business initiatives that consider definitely profits, but also socially inclusive people, ecologically friendly planet, and peace and prosperity, the penta-bottom line to the business enterprise. And finally, as we speak, we have 246 students learning how to be global leaders in 12 international locations. Let me just give you an example. Let us assume that some of you has a daughter, and her name is Olivia. Olivia comes to study with us for 3 semesters. Then she goes to Politecnico di Milano for 3 semesters in Italy. She does an internship. She enhances her Italiano. She develops a network. Then she returns to San Diego for 2 additional semesters. And in 4 years, with the same amount of money and time, Olivia has a European degree, an American degrees, 2 networks, 2 internships, and she becomes a global citizen. These 5 initiatives, working with the military community, entrepreneurship and innovation, small business development, peace through commerce, and global business environment, we really believe that this is going to produce a much better and more sustainable society. Basically, our legacy is education with purpose. Education which is relevant and responsive to markets, respectful and inclusive across diverse groups, lifestyles, and political borders, and has positive social, economic, financial prosperity and peace impact in our communities. This morning, ladies and gentlemen, we feel honored to join forces with all of you in creating a more sustainable, prosperous, and peaceful society. Welcome to the University of San Diego. Welcome to the School of Business. Welcome to this fundamentally tremendous economic forum. Good morning to all of you. And now I'm going to introduce Chief Editor, 10 times Chief Editor and Publisher of the San Diego, right here behind me, Union-Tribune, Jeff.
Dean, thank you very much. Very, very glad to be here. It's a great privilege to be one of the sponsors of this event. It's one of my favorite events of the year, not only because it fits so closely with our mission to inform the community about events of significance with information and insight, which I think is going to happen, but because as a business person and as a journalist, I'm keenly interested in what we're going to find out, because it seems to me like such a crazy time. Just a couple of months ago, I was at the South County EDC, and they had Chris Thornburg as a speaker. Fascinating. And his theme was how in this era of remarkable prosperity, the only things that could go wrong were policy intervention. And then he listed off all the things that he saw going wrong. Now, his theme was about how great the fundamentals were. And I think we'll hear today a little bit about 2018, because I took a peek, and it's a pretty remarkable year. And yet, you know, there's sort of something in the air. So we have this conversation, Diana McCabe, who's sitting over here, who's the business editor at the UT, and this will come up occasionally. And I'm always saying, yeah, but wait a minute. You know, isn't there going to be a shock? Isn't there going to be some terrible economic news? And she's always saying, no, look at the numbers, everything is strong. So I am really, really looking forward to hearing from the real experts what their perspective is. Pretty hard to predict the future, but this group's pretty good at it. And I think with that, I will turn the dais over to Peter Kallstrom, CEO of the San Diego Workforce Partnership, and our partner in sponsoring this event. Peter?
Good morning, everybody. Let's see. There we go. Just a little snapshot of what the Workforce Partnership is all about. In a nutshell, we bring in resources from around the country, from the federal government. That's about 2/3 or more of our funding right now, and I'll touch on that in a little bit because there's a few things going on with the federal government. But we also work with partnered funding through the County of San Diego, City of San Diego, other cities, private sector, and philanthropy. We pool around $35 million annually, and then we use that to fund and deliver job training, targeted job training programs throughout the county. We serve tens of thousands of people. We fund the Career Center Network where people go who've been displaced or looking for retraining or new training in order to get into in-demand jobs. And then we do a lot of research. My colleague Sarah will be talking about some of that. We really need to know where the jobs are, how to get them, and how to support people so we can fund the right services to serve people where they are and what they want to do. And then we convene. We do a lot of work in order to bring the community together. This is one example and a great collaboration with our partners. But we also have, in the spring, we do a youth summit. So mark your calendar, May 2nd at Town and Country, we'll be doing our 3rd annual Opportunity Summit. This summit focusing on the issue of disconnected, or better put, opportunity youth. We have over 41,000 young adults, 16 to 24, in our region who are not working and not in school. This is a nationwide crisis. 5 million young adults, approximately, almost 1 in 10. So we have to do more to re-engage these young adults to see their potential and to be able to fulfill their potential and find their place in the world of work. And then we measure what we do so we understand our impact and then share that with the community, which, again, Sarah will touch on today. So that's a little bit of what we're all about. We're thrilled to be partnering in this important forum over the years. And lastly, with the federal government funding, the shutdown is troubling to everybody. Politics aside, we hope it comes to a swift end. But as we see it, or as I see it, it's a barrier. It's a barrier to opportunity, to employment, when our government isn't there to serve who we are and what we're doing. So I just urge you, as a takeaway from the event today, share your opinion with your elected officials, because we don't need another barrier. Wall aside, whatever you want to call it, it's another barrier that impedes the American dream. Thank you.
All right, fantastic. So just to let everyone know, all the presentation materials that you see on screen today, it's going to be on the website because we decided to go green and not print everything out. So for me personally, I'm really glad to be back again this year. We've been really busy at the paper with a lot of different topics, namely the shutdown, the up and down of the stock market, and then, of course, the mayor's housing plan a couple days ago. So I'm hoping some of this stuff comes up. And just because I've been here for the last couple of years, it's kind of funny to think back, because I was remembering, like, in 2017, it was right before, Donald Trump got elected, and that was a huge topic of the economic forecast. And then last year, for whatever reason, it ended up being a lot about housing. So I'm really curious to see how it goes this year, and excited. So, just letting everybody know, the speakers' presentations, they're going to happen followed by a 15-minute break. And definitely encourage all of you to write down questions that you might have. There are people collecting questions throughout the room. They actually have like an index card where you would write them. And then they bring them up to me and I get to ask the panel. So if you could please do that, that would be excellent. All right, now for our first presentation, it is Ray Major. He's the chief economist for the San Diego Association of Governments, SANDAG, and he's responsible for the agency's short-term and long-term economic and demographic forecasting, the region's economic prosperity strategy, and impact analysis of regionally significant projects on the local economy.
Thank you. First, I have to find my slideshow, so that's the hard part. How many of you thought that 2018 was a better year than 2017? Yeah? Pretty good from an economic perspective? How many of you think 2019 is going to be a better year than 2018? Yeah, that's interesting. So there are some people who are optimistic here. But I work in the dismal science, so I'm going to have to bring up some of the negative stuff too that's happening in the economy. So when we take a look at what's happened in the last year, I thought we would just kind of take a look at what's happening in 2018 or what happened in 2018, and then I'm going to look forward to what is happening in 2019 in housing, employment, and wages, and I'll even put in some bonus slides in this particular deck that have to do with the long-term economic forecast that Sandag is doing to give you a perspective on where the region's going out to 2050. When we take a look at some of the things that are happening nationally, we see that there's continued strong job growth. That's what the numbers are showing. We also see that we have very low unemployment rates, and you see news articles all the time about unemployment continuously hitting all-time lows. You see that we have relatively low interest rates compared to historical norms, and we have healthy venture capital investment in firms that help fuel high tech, for instance, and biotech. But on the negative side, in 2018 also, the stock market gave back all of its gains. How many people got rich last year on the stock market? That's great. One person in the audience got rich doing that. So you should probably be in the Bahamas instead of here listening to this particular presentation. We also saw slower economic growth, though. We start to see some headwinds in the national economy. And trade and politics are really much more of a theme now than they were in the past decade. And that is also starting to impact the economy when it comes especially to uncertainty with things like trade with China, for instance, and whether or not businesses that are right across the border can do business with San Diego. And interest rates and debt are rising in the economy, too. So what I wanted to take a look at first is what's happened to employment in San Diego in the last, goes back to January of 2000, and you can see how the gray bar represents the recession. The last time the economy peaked in terms of economic employment was in December of 2007. Okay, that was the peak, and then we entered a recession, and we lost about 100,000 jobs, and the trough was in January 2010, and then you see we recovered by June of 2014. So this was a 78-month recovery. This was one of the longest recoveries in history. Usually you get out of a recession much more quickly than this. But what happened when we lost these jobs is that we lost core jobs in construction and in manufacturing, some relatively high-paying sectors. And as we came out of the economy, and we enter now 107 months of straight economic growth in terms of employment, what's happened is that we've replaced these jobs with relatively low-paying jobs. So about 70% of the job creation here in San Diego is in low-paying sectors. So 2 out of 3 jobs that are created, 2 of them are low-paying. So what's happened is that average incomes have not gone up as much as we would like them to, and we'll look at that later. So with all of these people working, what has that done to total employment? This graph shows what total employment looks like. The green bars represent the total employment in the economy. And you can see that last bar is actually really high. A lot of people were hired last year. Anyone who wanted a job could pretty much get a job right now. About 46% of employers are now reporting that they are having problems being able to hire people into the workforce. And that's because all of the good people are already employed. If you have a skill, you can probably get a job. And you see unemployment rates have fallen too. So we're at about 3.5% unemployment right now. That is at what we would consider full employment as economists. And I see in the future that this is going to probably flatten out here. It can't go much lower than that. And I think with that also says that employment can't go much higher in terms of percent increases just because there aren't any people to hire unless you incentivize them to come to San Diego. And we know it's very expensive to live here and it's hard to bring people here. So we take a look at the wages and what's happened since the economy has recovered or came out of the recession. And interestingly enough, the gray bar again represents the recession. You'll see that as we came out of the recession, nominal wages were rising. Then they kind of flattened out, but people were making more money. And now we look at ahead about 10, 11 years, and you see that in nominal sense, the dollars that you're earning, wages are up about 26% for the top 25% of wage earners and about 26% for the lowest wage earners, the lowest 25%, and median income is up about 25% for the median. Okay? So that's great. But what happens when we correct this for inflation? Because then that shows us what our buying power really is. And what we see is that in terms of real wages, we haven't made a lot of progress since the Great Recession. I thought you wanted me to move. All right. So, because I can do that too, but I was supposed to do economics today, so I don't know. So, when we look at this in terms of real hourly wages, what we see is that we haven't really made any progress in terms of buying power. How many people feel now that they have more purchasing power than they did 10 years ago if you're working? See, this is part of the problem. And when you look at inflation, it doesn't include some core things. For instance, food and fuel, like gasoline. So like a steak that cost probably $6, $7 10 years ago is now $20, $22 a pound, something like that. So that's not factored into the inflation rate. So real hourly wages have not gone up. That's a problem here in San Diego. So here's some of the bonus slides. I wanted to talk about the growth forecast for 2018 through 2050. My crack team of economists who are sitting over here did this forecast. So if you don't like the numbers, you can talk to them over there. But we think that we will have about 4 million people who are going to be in the region by 2050. Okay? And a lot of that increase is from natural increase, but it's also in migration, people moving in. A lot of it is foreign in migration. So with that, we're going to have a population increase of about 700,000 people. We're going to need to house them somewhere. So we have about 400,000 new housing units that we have to put somewhere. And the mayor talked about that just in the last couple of days because we do have a housing crisis here in the San Diego region. And with that, there's probably about 360,000 jobs that will be created in the region. So let's take a look at the age composition of the population now and in the future. If you take a look at the blue bars, what you see is the age population. This is a pyramid by 5-year age category, the number of people in each one of those age categories. And you see kind of that it's flat, and then it kind of tapers off as people get older, out into the 75 to, let me see if I can do this. Nah, I'll forget it. You can see it. Just look at the slide. Okay, right over here. Okay. So as you can see, it tapers off as we get older. And 81% of the population growth is going to be in age 65 plus. And this is an interesting statistic. So if you take a look at people who are right now between 30 and 40 years old, okay, so we're looking at kind of the Gen X generation, okay, they're in the blue, this is where they are now. And this is where they're going to be at the end of the forecast. So all of you out there who are thinking this is an old people's problem, it's actually your problem because you're the old people. In the future here, you end up being this population of old people. Now, think about what a community needs to look like that has the predominant population is now age 65 plus. And with advances in medical technology, we're doing forecasts now out to the age 100. By 2050, that's going to be a very common age for people to live to. So how does the region need to change to accommodate that? It's an interesting question to ponder. When we take a look at 2018, this is a map of San Diego County, and what it shows is the distribution of jobs and housing. So the yellow dots represent housing units. There's 50 housing units per dot, and the blue represent the jobs. And you can see that the jobs are all kind of located and clustered in what we call employment centers. Okay? And I'll show you the map for 2050. Okay? So at first, when they gave me this map, I thought this must be a mistake. It looks exactly like the 2018 map. But the truth of the matter is that the way that the general plans work, and my team works with all of the different jurisdictions to collect their general plans and understand where they're going to allow housing and jobs, is that essentially that 700,000 people and the 360,000 jobs and the 400,000 housing units are all going to be located in the same urban core where it is now. There's very little expansion that's going to be happening in the eastern part of the county. So what you're going to see is tremendous amount of densification. And you see some of the political pressures to make that happen. And you see that even Mayor Faulkner talked about that in his State of the City address, that we need to densify around things like transit stations. And the reason is that this is what's in the general plan. So how are we doing at building houses? This graph goes all the way back to 1970, and it takes a look at the number of building permits that have been issued. The blue lines kind of represent the 10-year averages, but you can see when certain areas, for those of you who've been here in San Diego, you can see kind of when things were built out. So when Carmel Valley was built out, and Poway, you see we were building 30, 40,000 units a year. Okay, were made available in these massive housing tracts. So we would just, flatten a bunch of land and put the housing in. And what you see is by 2000s, that had slowed, but we were building enough houses to keep up with demand. Currently, just because of natural increase, we need about 12,000 additional units per year built just to accommodate the people who are coming to the region, either being born or moving in. Well, we haven't built that many housing units since 2005. So we've been accumulating this shortage, and we now have a shortage that we estimate to be somewhere around 56,000 units in terms of backlog that needs to be built. And you can even see now, as the economic times have been relatively good the last couple of years, as we came out of this recession, housing has not kept up. And this year we anticipate probably 10,000 units or so will be what's built in 2018. So definitely have a problem with building units, and we can't build the way that we did in the past. We're going to have to build more infill, and that's a much more difficult process to do, and fewer units at a time. So that's something that you might want to watch as we move forward. In terms of the real estate market, again, this graph shows the number of housing units in the bars, and it shows the average price. And as everybody knows in San Diego, average price of housing has continued to go up, right? Single-family house is now about $637,000. And what's happened, though, is you see that the volume of houses, the number of units that are actually sold, is starting to fall. Okay? The last time you saw this happen is over here, right before we entered the recession, right? Part of the problem that we're seeing, though, is that the sellers are not willing necessarily to come down on their price, and so it's kind of turning into a buyer's market, but there are fewer and fewer people who are actually able to afford to purchase those houses. So, and in terms of housing affordability, what this graph shows is how many people are able to afford a house in San Diego. The blue line represents San Diego. This green line over here is the United States. So you see, as we went into the recession last time, about 9% of the San Diego residents were able to afford a home. When we went into the recession, housing prices came down precipitously, as did interest rates, and it went up to about 46% affordability. Okay? And then as prices rose and we came out of the recession, you see it's kind of creeped down to 23%. Okay? The unfortunate thing is right here at 46%, when you think that you would be able to then have a lot of people become homeowners and have the dream of home ownership, that's when you had all these people coming in doing cash offers and buying houses and flipping them. And so the real profit in all of that was not made by the residents of San Diego, it was made by investors who were doing these flips during that time in the market. So let's take a look at what it actually costs to purchase a house here. So if you have the median income, if you make the average income in San Diego right now is about $58,000. That's because we have a lot of low-paying jobs that we've created. If you are going out and buying a house, you have one income, and you have about $500 a month in debt, you could probably afford a unit that was about $193,000. Okay? So you're not buying a house, right? So two people get together and they decide that they're going to purchase a house, and they both have the average income. What can they afford? They can afford about $397,000, okay, in terms of house. How many housing units are out there right now in San Diego that are $397,000, okay? And we take a look at what it would take to actually purchase the average price house in San Diego, or the median priced house, and we see that it's about two incomes of $82,500, okay? This starts to push you up into that high-paying category of, if you're working in biotech or you're working in some of the healthcare fields, you might make this much money, and you can, with a dual income, you can still afford to buy the median price home. So one might wonder, why was it 9% over here when housing prices are actually higher over here, and we talked about the fact that income hasn't risen really over the last 10 years. Well, what's the difference? Why can 23% of the people afford it? The only difference between here and here is really the interest rates that are being charged. Okay? So if you take a $500,000 loan, every percent on your interest rate is going to cost you about $300 additionally in mortgage, and that means a lot of people can't afford to buy. Over here, the interest rate is about 4%. Over here, it's about 6.5%. That's the only difference in affordability. So as you see interest rates start to creep up, what you're going to see is affordability come down precipitously in San Diego. So this is my last slide, just talk a little bit about what I think is going to happen in 2019. I think that the national economy is going to start to slow. I think gross domestic product was up about 3% in 2018. There's a lot of headwinds for the economy, and I think that it's going to slow, probably somewhere between 2 and 2.5%. I'm going to be optimistic and say 2.5%. The Fed continues to raise the Fed fund rate, and they're using that as a control for inflation. Inflation has started to creep back into the economy. As they raise those interest rates, it's going to impact adjustable rate mortgages first, and then eventually the fixed rate mortgages will also be affected for different reasons. But what I see happening there is that they'll probably raise a couple more times in 2019, taking the Fed fund rate back up to about 3%. In terms of housing prices in San Diego, that's something everybody keeps asking me. I think that the prices continue to go up. I think that the volume goes down. I don't think that the sellers right now are reasonable about what they should be getting for their property, but prices will probably continue to rise at this point. And there's also a lot of pent-up demand because we're just not building enough units. So people are willing to pay larger and larger percentages of their income if they can to afford a home. And finally, taxable retail sales, which is really a indicator of economic confidence by people, is like how much you're willing to spend. In 2018, it was up about 4.1%. I see it rising slowly in 2019. But people, I think, are going to be more cautious in some of the purchases that they make. So with that, I thank you for your attention. And if you need to contact me, here's my information.
Okay, thank you so much. Now we have Ryan Ratcliffe, Associate Professor of Economics at the University of San Diego School of Business. He specializes in forecasting, macroeconomics, and financial economics, and his research interests include the formation and updating of macroeconomic expectations, linkages between the financial markets and the macroeconomy, state and regional economic forecasting, and the macroeconomic impact of housing cycles.
Okay, good morning, and I also want to welcome you to USD. And so, as both an academic and in particular a forecaster, what I'd like to do with my time is kind of step back a little bit and talk about. I have the same feeling that I think a lot of our friends from the UT were describing about the 2018 was pretty good according to all of the numbers, but there's a little whiff of something in the air. So I want to talk a little bit more about what a whiff of something in the air smells like to somebody like me. And in particular, what I want to focus on is the question of what historically. So a lot of this is going to be informed by going all the way back to 1948, kind of looking at all the recessions that have happened and asking what commonalities are there in the year before a recession. So this is really the question of forecasting. What can you see today that tells you that in the next 9 to 12 months, historically, when we see this today, a recession has occurred in that time frame later. And there are, here are some of the usual suspects. Many of these cry wolf a lot. There's a lot of false positives here, but the best three that I want to look at today are this. So if you made me pick just one, I would say the best predictor we have for something you can see today that'll tell you 9 to 12 months in the future there's going to be a recession is the so-called inverted yield curve. So what we're doing here is looking at short-term interest rates and comparing them to long-term interest rates. Typically, the 3-month T-bill is going to have an interest rate that's about 2% lower than what you would get on a 10-year Treasury bond. But every now and again, you see the kind of interesting scenario where that 3-month T-bill actually pays a higher interest rate than the long-term interest rate. And when you see that particular combination of interest rates, it tends to be one of the things you see the year before a recession. So we're going to take a look at sort of the historical evidence and where we are now on that. Not surprisingly, another place where you can see sort of the first hints of the turn from the end of an expansion or the end of a boom economy into the beginning of a recession is in some of the big spending items that both households and firms do. So for instance, forward-looking spending that you're typically borrowing money to do on the consumer side, that's houses and cars, right? And so Some of the spending that we typically see as a leading indicator on the consumer side is home purchases and auto purchases. And then on the firm side, right, you're thinking that firms are in the situation of, based on what I see today, is now a time that I want to expand my operations, build out my capacity to make stuff. And so that's a very forward-looking decision on behalf of the firms. So if you see firms pulling back on these expansion plans, that's a signal that they are less optimistic about the future. And so that's another thing we'll look at. And then, of course, with the last quarter, end of 18, that we lived through in the stock market, we'll want to take a look at that. The joke, of course, is that the stock market's predicted the last 10 of 8 recessions that we've had. So we'll kind of get into that a little bit, too. Just as context, so what we're looking at here is just the unemployment rate in the United States. Using the typical economist trick of gray bars have been the recessions. We're going into the Wayback Machine here, there. And the numbers are just how many months did we go from the end of the last recession to the beginning of the next one here. And really this graph, just for context, is that the Great Recession ended in July of 2009. So we're coming up on 9.5 years since the last recession ended. And that is the second biggest number in this whole picture, right? We've gone longer since the last recession than we have at any time except for the 90s. And when we get to the summer, we're going to now be, if we hit July 19, obviously that'll be 10 years exactly. And that'll be tied for the longest expansion in post-war history. So there's no, like, we're due because the clock says so, right? There's no economic theory that I can tell you that says that there's some counter in the economy that hits a magic month number and then we have a recession. But just for historical context, the expansion we're in right now has lasted a really, really, really long time. Okay, so interest rates. Again, what I've done here, this graph here is just looking at taking the interest rate on the 10-year Treasury, which is about 2.7 right now, and subtracting the T-bond from it. Again, you can kind of just draw a line across this picture and see that the average is about 2%. First thing to see in this picture, of course, is just looking that this number seems to hit 0 about 9 to 12 months before every gray bar. I've only got a couple of gray bars here in the picture because I really wanted to focus in on what's going on lately. But this is the best one we have. I think if you look back to 1960 at the 8 recessions that we've had, the yield curve has inverted 9 times. And 8 of those 9 times we had a recession 9 to 12 months later. So this one is the one that has kind of the best track record of there's only one false positive in the record. So we're closing in on 0 again here. You can see at the very right-hand side of the picture, we haven't inverted yet, but we're getting down now where the wedge between these two interest rates is less than 1%. I'm doing this as a monthly average, by the way. There are times where you might get an inversion for a day based on some quirk of the bond market, and I want to smooth that out a little bit. So the question, of course, is, are we actually going to hit that inversion? And if we do, so this is one thing I'm keeping an eye on. So I would say there's good, you can look at this and say the glass is half full or the glass is half empty. By that, I mean we're not inverted yet. So the most reliable signal I've got in my toolkit is not triggering the recession in the next 9 months warning. That's the good news. The more ominous news is we're getting very, very close. And I think, we saw a projection of what the Fed might do with these short-term interest rates. These kind of continued 25 basis point, 0.25% hikes. About summer then, that's going to take us into this range where we're getting very close to 0 here on this number. So this is one of the things I'm going to keep a very, very close eye on in the next 6 months. Again, the warning isn't going off yet, but we're getting close enough that this is one of the things I'm going to pay a lot of attention to. With that in mind, I want to talk a little bit about, I think, what the Fed has on its mind right now. So, the Fed really has 2 things in its mission statement. Maximum employment and stable prices. More to the point, let's say they want to keep inflation somewhere around 2 to 2.5%. And if there is a rise in unemployment, they want to use their power to lower interest rates to stimulate the economy to try and do something about that. Unemployment's not currently a concern. The rising interest rate environment says that is kind of the typical playbook for worried about inflation. So the panel on the left side here is what's going on with inflation. There has been an uptick recently, but we're still in the 2 to 2.5% zone, which is kind of what the Fed wants it to be, right? If you look at before the Great Recession, again, that gray bar there, you can see we were looking at inflation that was more around 4% or so, and this is where Bernanke was really in a pinch of, do I raise interest rates or not, based on what's going on with inflation there, but we're not there now, right? So one of the big, kind of the Fed's on the horns of a dilemma right now. There's this feeling that interest rates have been so low for so long, we got to get back to normal, whatever normal is. So we need to raise them a little bit, because 2.5% is still really low. But if we keep raising interest rates and there's this kind of feeling that maybe we're coming close to a turning point and we're seeing the yield curve starting to flatten out, maybe we shouldn't raise them. Maybe we should just keep them where they are. And I think there's a lot of debate at the Fed around this right now, that 2.5% is still really low, especially when you just kind of do the calculation of nominal interest rates are 2.5% right now. We got about 2 to 2.5% inflation. When you look at a real interest rate, which is the thing that people like me think matters, you're still pretty close to zero, right? So this still feels like a really low interest rate by historical standards, suggesting we ought to try to normalize back to something more like 4%. But there's no argument for rising inflation saying you should raise interest rates, right? So there's a real, we've never seen anything like this before, I'm not sure what to do. Let's just raise by 25 basis points again, because that's what everybody expects us to do, and it won't freak anybody out. So like I say, the Fed's in a real kind of puzzling situation right now. I think they're going to be in a wait-and-see mode. They're going to go to that kind of data-dependent, let's see what happens with inflation, and that'll determine what we're going to do with interest rates. But if they kind of keep on this same trajectory, then we're going to see that inversion sometime, probably in the summertime of this year. But they know that. So like I say, I'd say keep an eye on if you're worried about inversion, as I've tried to convince you should be, keep an eye on what the Fed is saying. And I don't know, I expect the next meeting there's going to be a lot of hand-wringing about exactly this. There's a lot of downside if we do raise, but we kind of need to raise because we've been so low for so long. What do we do? Which way that tilts, I think, is going to tell us a lot about what to expect in the coming quarters. Okay, so I said second thing is forward-looking purchases by consumers. So I'm going to give you my housing market slide. I'm going to say exactly the same things that we heard here from Murray. So the left hand is the kind of local markets. It's Southern California, just to show you that basically San Diego is not doing its own thing here. This is this kind of weird realtor way of looking at the world of how many months of inventory are there. So total amount of homes that sold this month divided by total amount of homes that were offered for sale or listed this month. That number's going up, and it has been for several months in a row now. That's a sign. As we saw in the last presentation, sales are slowing down. And a slowdown in the housing market is one of those kind of early warnings that we have, right? This is, so if you want to think back to the Great Recession, this is kind of what we saw in 2006. Recession didn't start till the end of 2007, but in 2006 we started to see a slowdown in sales volume. On the right-hand side, this is the national number. This is the incredibly wonky way to describe building new houses. So what this is just how much money did we spend on new home construction relative to the year before. Again, gray bars are what we're looking at for context here. This number crosses into negative territory before every gray bar in the graph I'm showing you here, but you can see there's a lot of twitchiness and false positives in this number. So I rely on this one a little less than before because it tends to cry wolf a little more. You can look at the 90s to see that. But again, at a national level, we're sort of basically seeing that we're not spending more on new home construction than we did the year before. So the combination of, locally we see people buying fewer homes, and nationally we see less home building. Those are, again, some of the ominous signs that have preceded past recessions. Okay, the stock market, I think, is the reason that a lot of us are even having this conversation in the first place. Having seen the slide that we saw in the fourth quarter here. I picked the biggest, broadest stock market index there is, the Wilshire 5000 here, and again, we're just looking at year-over-year growth. The end of that, again, for some context, when does that blue line cross zero? When do we see the actual decline in this very broad stock market index? I see a lot of times where that number is crossing below zero before a gray bar, but I see a lot of times where that number crosses below zero and we don't have a gray bar. So again, the stock market here is a not very reliable leading indicator, right? There's a lot of times where it does decline before a recession. There's a lot of times where it declines and we don't have a recession in the window I'm looking at. So I am a little bit more, I don't know, I put a little bit less weight on the stock market indicator, but I will say that I think just a lot of people will say the psychology of the stock market is about the balance of fear and greed, right? And I think what the market recently has felt like to me is everybody's looking around going, I don't know what the story is anymore. I see good earnings, so optimism starts to get back in, and we see a nice little run up. And then I see some political news, some particular stories say about, GM deciding to shutter a plant based on weak demand for certain types of cars. Okay, that's it. This is the end of the party. I got to run for the exit now. And we see, 5. And you see that kind of just volatility, switching back and forth between those two psychologies almost on a daily basis. To me, that's just this is a very kind of late bull market, late economic expansion feeling of, I'm not sure which of these is true. Is it the good news we've experienced recently, or is it that whiff that something bad is kind of around the corner? I don't know which one it is. So a market that's very, very sensitive to seemingly very, very small news items is a very typical late market kind of, we all know that we're due sometime soon here, but we're not sure if it's now or 6 months from now. So I think that's kind of the my takeaway from the stock market side of things. You don't want to put too much weight on this because it cries wolf a lot, but at the same time, this this back and forth between fear and greed, I think, is a lot of what we've seen before previous recessions. Okay, so let me put that all together. Like I say, this is me lifting up the hood, telling you, look, this is what I look at. This is how I make this call. We've been in an almost unprecedented length of the current economic expansion, again, closing in on 10 years, and that's high by historical standards. Everything we see right now is kind of the 8th, 9th inning of an expansion, right? Really, really low employment, a kind of fragile stock market, flattening yield curve based on rising short-term rates. All of this is kind of your typical, it's winding down, but nothing yet looks like we've crossed over that. Okay, 9 to 12 months from now, the most reliable indicators say that we're going to start a recession, right? We're not there yet. It's starting to feel like we might be soon, but we're not there yet. Right? So I think a lot of, the interesting thing was, I think I go back to the end of 2016 and I started to see a few of these things going on too. So I think some of what we're seeing is that we got a boost to consumption and investment spending from the tax cuts. It's starting to peter out a little bit. And I would say a good way to think about the shutdown as it moves from being just sort of a temporary 7 days of you don't get paid this time, but we're going to back pay you next time, which is what every shutdown in the past has been, into something that's lasting, weeks, and if we're going to start to soon measure it in months. This is exactly the opposite. As opposed to the government providing a boost to the private sector, what we're seeing is, declines in government, and all of these have ripples. We're not buying from contractors who have less money to buy stuff and are not going to buy houses and cars and all that. So I think the shutdown, we don't have any historical precedent for what to make of this. One has never lasted this long. They've always been blips on the economic radar. We're moving to the point where this one's going to be different now, and I think this is, that's my single biggest worry, is that one thing I am absolutely guaranteeing as a macroeconomist is that if the government significantly ramps back its spending, it has the ability to create a recession. All you have to do is look at the demobilization from World War II, where we created a recession that dwarfed the Great Recession, just on the basis of a ramp down of government spending. So that's a big concern of mine. again, this is a very wishy-washy signal, which is echoing some of, I think, what you heard in the last presentation. I would say the probability of a recession in the next year is rising, but we have not crossed the threshold of this is where I would have called it last time. Ask me again in 6 months. We'll see how that interest rate situation pans out. Keep an eye on home sales and all. So I would say, we're looking at kind of end of 19, early 20, based on the best guess of how these things have played out in the past. If we are going to have a recession, that would be the timing of it, I think. And then, just to speak specifically to housing markets, I think that's always an interest here, because I have a lot of colleagues that I work with here who have moved here from somewhere else, and they look at housing prices and they go, oh my God. And then they look on Zillow or Redfin or whatever, and they give them a graph that goes back to 2005 or so, and they say, oh, okay, I'll just wait till the next recession, house prices will drop 25%, and then I'm going to move in and buy. And I just go, can you look at the graph a little longer than that? So if we were to move into a housing slowdown, I expect it's not going to be the distressed sales based on over-leverage that we saw last time around. I think it's going to be much more, as Ray was describing, that we see a drop in volume. And home prices just kind of go flat to slightly down a little bit, but no, now there's a fire sale and it's time to buy. Right, this is what a housing market slowdown in Southern California looked like in the early 80s, the early 90s. 2008, 2009 was a real anomaly, and I think if we see a slowdown, it would be more of that nature. A volume slowdown and kind of just flat prices for there. So, like I said, there's a lot of stuff I wasn't able to talk about there, but I think that's my kind of more academics perspective on if you're going to forecast when the next recession is going to happen, here are the best tools we have, and here's my current read of them. So I'll be happy to answer any questions, but that's the end of my presentation. Thank you.
Okay, great job, Ryan. Okay, next we have Sarah Burns. She's the Director of Business Programs and Research over at the San Diego Workforce Partnership. She produces labor market research to identify demand industries, occupations, skills in San Diego County. She leverages her professional practice and degrees in economics and math education to support successful labor market outcomes for San Diegans with a passion for students and the younger workforce. Here's Sarah Burns.
Good morning, everybody. Thanks for being here this morning. As Peter told you a little bit about this morning, I'm with the San Diego Workforce Partnership, and I specialize in looking at the San Diego labor market. So I'd like to start by contesting Ray's claim that there aren't any people to hire by looking at this, which shows us there are 51,300 people as of November out there looking for work, and they have not been able to secure it. The top bar is showing one representation, one estimate of online job postings, unique online job postings. So if this estimate's accurate, we're looking at twice as many job postings as people who are looking for work. Hypothetically, it would be great if we could just take those people, put them in those jobs, call it a day. But we know that there's some misalignment here between what employers are looking for and what the labor market has. And that's really where we come in and where we think everyone can come in helping to prepare the people in our labor market for what our employers need. So let's get acquainted with this. This is looking at our labor market by occupation. Every one of these little circles represents one of the about 750 occupations in San Diego County. And if you look on the horizontal axis, we're looking at the annual openings projected for the next 5 years. We're looking at our future need rather than our immediate need. And if we look at our vertical, we're looking at 10th percentile wage, which we think of as entry-level wages. And this L shape might not be natural when you think about our labor market. You might think higher demand should mean higher wages, which makes sense until you start to think about the supply. When you look at what our extremes are for reference, in this bottom right, we have combined food preparation and serving workers, including fast food. And you'll see that trend really in that whole bottom line, where we're looking at these low-income jobs that Ray mentioned that we've been creating in our economy. And you see on the top left a really, really specialized job that needs a ton of training, maybe not as many annual openings, but because of that, there's a premium on that wage. And just to give you an idea of what some of those other high annual opening projected occupations are for the next 5 years, it really is all in those low wage categories. And we're looking at tens of thousands of people who we need for those occupations. But at the same time, we can be most effective as a workforce board when we zoom in a little bit. And so this is a version, a sort of zoomed in version, where we're looking at least the self-sustaining wage. So $16 an hour is self-sufficiency for one individual in San Diego County. So these are occupations that only pay above $16 an hour. And then 63 is the median number of annual openings projected for the next 5 years. So all of these occupations have at least 63 openings. They have at least $16 a wage, and we filtered also for above average annual growth. And we come to this set of occupations that we call our priority occupations. If you look at our extremes here, we're looking at general and operations managers and physicians and surgeons, all other. And those all other categories means they're so specialized that they don't have a code that's big enough to categorize them as their own things. They're really specialized physicians and surgeons. But really, these span the gamut in terms of education qualifications, in terms of wages, you can see. And if you look at what comes next, well, actually, first, we're looking at 72 occupations here, but that's accounting for over 23,000 annual openings a year for the next 5 years. So how do we get people prepared to fill these high priority occupations that can pay them well? And these are these top 5 now by annual openings in terms of the numbers we need. So you can see in education, we're looking in finance, we're looking in healthcare, and some tech occupations as well. So what we did is we took about 3/4 of these jobs and we surveyed the employers in San Diego County to find out what is it that they're looking for, how does that compare with national data that we have on these occupations. We'll be releasing our priority jobs report later this month, but this is your sneak preview for now. And we had about an average of 8.5 responses per occupation and surveyed over 250 employers. And so let's start with education. That's really, when you're talking about getting a job, you're talking about growing up, going to college, getting a job. But what does that really mean? And is going to college the thing that employers are looking for all these occupations? So you can see where there's a concentration in that sort of middle section, where you're seeing about 50% are looking for this range of anything from a certificate or associate degree all the way up to the bachelor's and specialized certificate. And then there's a smaller number where we're looking at the high school graduate equivalent, the no formal education, and smaller on the other side with advanced degrees as well. And remember, we're only looking at these priority occupations now, not the whole gamut of occupations in San Diego. And so we're going to dig down into some of these particular categories. These are the priority occupations we're talking about in what I call sort of the basic education level. And the employer responses match pretty much what our Bureau of Labor Statistics data tells us, that this is what employers are looking for. One to look at here in particular that might be changing in the coming years is the electrical power line installers and repairers. As drone technology gets more advanced, that's now how we're going out and inspecting those lines. So that occupation's not necessarily going away, but you might be looking for higher qualifications, a certificate in drone piloting, for example. So that wage will still probably be on the higher end for this category. There might be more certifications involved. If we look at this next level, which is frequently called middle skill jobs, but when you look at actually what's listed on here, there doesn't look to be any middle skill. They're all very highly skilled occupations. It's really middle education. So some kind of post-secondary degree, not quite a bachelor's, is required for these. And again, our local employer expectations are mostly on par with the national findings, but a couple of these stood out. For example, the licensed practical and vocational nurses, actually 44% of our employers were looking for a bachelor's degree. So it is the majority looking for one of these post-secondary non-degrees, but there is a large number who are looking for bachelor's. And similar with aerospace engineering and operations technicians down at the bottom there, And about 50% of our respondents were talking about looking for a bachelor's plus a certificate, so not just the certificate for those occupations. Okay, the bachelor's degree. This is the chunk where there's really the most variation in what employers are looking for. Yes, the data tells us that it is most common that someone in this job has a bachelor's degree, but employers aren't necessarily always looking for that. And a couple that stand out here are app developers, so software developers for applications. 55% of our employers are looking for bachelor's degrees, but the rest are all looking for something else. So that's a great place for us to start looking when we're talking about how do we meet our immediate needs, and what kind of quick turnaround occupations and certifications can we help people to get to move up in their career or get employed. And that's one of them. Another one is those operations research analysts. That was really scattered, everything down from no formal education required all the way up to a master's degree. So it's a place where we know that there's room to work with job seekers. If you look at fundraisers, 40% of them only required a high school education. There's a chunk that required bachelor's, a chunk that required master's, but it's something you can start in earlier. And then cost estimators as well. 50% of them were high school degree. And when we're looking at these advanced occupations or advanced education occupations, this also starts to align again with the expectations because many of these are restricted by licensing requirements or other regulations that say you need to have this advanced degree. The one that stood out here as varying a little bit is librarians, actually. 60% of our respondents were looking for a bachelor's degree there, and 25% were looking at high school or certificate. So you can imagine it depends on where you're working. If you're working in a university library, you're probably looking at that master's degree. If you're looking in a local library, you can probably start there and build your career up to that. So that's a lot of detailed information on what we're looking at in terms of occupations that are priorities in the next few years. Another thing that employers told us about is what they expect for work experience, and this one's really important. Our BLS data says that 46 of these 54 priority jobs that we were surveying required no formal work experience. So that's about 85% of the jobs require no formal work experience. However, 89% of our respondents locally said that they're looking for work experience in their applicants. None of the occupations unanimously said there's no work experience required. If you dig down a little bit, this is the kind of work experience they're looking for. And it's frequently work in a related position rather than that specific position. But it's looking at 6 months to 2 years of experience. Another way, we asked, where are you having most difficulty finding qualified applicants in general? And the number one thing, and they could pick more than one here, so it's more than 100%, is relevant work experience. Again, that's what they're needing. But then we look at this question where we asked, well, what kind of career development are you offering at your company? And I think these numbers are dismal. Like 57% said on-the-job training. That should be 100%, right? Everybody gets on-the-job training when you get your job. I don't know what's going on in these places, but no. But the other ones that stand out are look at apprenticeships and job shadowing and internships, mentoring, job rotation. Where do companies think experience is going to come from if they're not offering it? So it's really, really important for us all to think about how do we encourage our economy? If there are tens of thousands of companies in San Diego, if they all committed to one internship, we can have every student at every high school in an internship. Everybody has a role in closing that gap. We know that we have long-term needs. We know we have short-term needs. We know we have people who can get jobs here. We just need to help them find the way. And one way that we are framing this as an organization is through these 5 buckets. And we've committed as an organization to concentrating on these things in the next few years, and we'll be encouraging the community in general to be thinking about them as well. Promoting job quality, 2-generational solutions. Maybe there's people who are being kept from the workforce because they can't afford or can't find childcare. Outcomes-based funding, which I'll tell you a little about in a minute. Inclusive business growth and population-specific interventions. Not every job seeker is the same. Not every person has the same needs. So how do we start to target what's going to help that person get over that hump? So remember, this is our immediate need. Here's our 51,000 people. How do we address these short-term needs? One thing that we're going to be piloting in 2019 is income sharing agreements. So this is not new in education in general. What this means is instead of paying for your education up front or taking out a loan, students can sign an agreement that after you complete your education and become employed with a minimum wage, you're paying back a percentage of your income for some fixed amount of time to some fixed cap. Again, if you don't get employed at a certain income level, you're not paying anything back. So we're focusing on holding ourselves and our education institutions accountable to outcomes. If we want to be repaid, we want people to be successful. We're piloting this with UC San Diego. We'll be focusing on 4 particular programs in their extension programs, focusing in IT and tech fields in general. And we haven't finalized them yet, but you can ask anybody in our organization for more information if that's something that is exciting to you. But this really helps people to get over that barrier of, I can't qualify for a loan. I don't have the funds to pay for this certificate on my own. This is a 9-month certificate. And they can receive this education and break through and have the opportunity to connect meaningfully with the workforce. Another small thing is employers think before you post. What is the education level that's actually necessary for the job you're posting for? Are you eliminating qualified applicants from your pool because of artificially high expectations there? And expand your network. Make sure your job posting is seen by a broad range of applicants so we can help them to get there. We're thinking about our long-term need, and this long-term is really only 5 years right now, but again, over 23,000 annual openings just for these 72 occupations in the next 5 years. There's a couple things we can do. Number one is everybody should get smart about the local labor market, and so we've invested in this tool that you can find at the website below, but it's called Career Coach, and you can take a career assessment that will align with different careers and local education programs. It will then connect you right to jobs that are open, so you can see the whole way through what's happening. And you can get data like this. Wages for a software developer, for example. People have artificial expectations of what they're going to get entering the labor market here. So being realistic and understanding that will also help you to understand more. You start around 56K. That's really tiny. I don't think you can see it. But that's 10th percentile. That's entry-level wage. You're not making $200,000 out the gate. Once you get up to the 90th percentile, you're making about $150,000. But you need to help students and help job seekers to understand what's out there, how they can grow their career and continue to progress. And really, every single person can help with this, and it's engaging the next generation. That's talking about our long-term pipeline for talent in San Diego. This is one example in Cajon Valley School District. They have now been they're in their 2nd year of this World of Work initiative, where they have curriculum specifically around the world of work for elementary through middle school and high school students. So they focus on teaching students about their strengths and their interests and what that might suit them to do, and exposing them to more than your doctor, lawyer, teacher, the things that we're all exposed to, or whatever your parent does. I mean, I grew up wanting to be a pension actuary. Who wants that? But if that's what your mom or dad does, then that's what you know. The world of work, though, helps them to hear about it. They have people Skyping into class to do interviews about their occupation. It's 20 minutes that somebody can give to a school to help develop and expose our next generation to what is out there for them. And of course, companies can work on these couple of things that will help to, again, get people the work experience, whether in school or not. University of San Diego, as you heard, has these great internship programs that their business students go through. So we want master's program people, and we want high school people, and we want middle school kids and elementary students to be aware of what's out there, and that's only if our employers can also engage. So that's all I've got for you today. Thank you very much. I'm happy to take any of your questions later.
All right, great job. So we have about 15 minutes for questions, and then we'll take a break. I think. Let me check. Yes, we have about 18 minutes for questions. So just for the panelists that already spoke, we'll be asking you questions. And, you know, if anybody in the audience wants to provide a question, I'll make sure to use it. So our first question is about the mayor's housing program, or his speech and sort of his hopes for growing housing in the city of San Diego. If you didn't happen to see it, he talked about like increasing the need for more housing, and the ways he would do that is sort of like changing height requirements and a whole bunch of other measures. And so I'm wondering for our panelists, maybe Ray Major could start first. Is it sort of not misguided, but if the city of San Diego is already building much more housing than maybe the surrounding communities, is it going to be kind of tough, even if the mayor gets all these things done? You're still not really convincing Poway or Carlsbad to build housing. So kind of wondering what your thoughts are on that.
Well, there's only a couple of ways that you can really build housing in a community that's already built out, and that's either going to be to build in greenfield areas where there's nothing built, or densification of existing areas. So those are really the two choices right now. And I think that the real dialogue that we're starting to have is between the citizens who don't want any new housing in their communities and the only place that new housing can be built, which is in their communities. So it's going to be interesting to watch. You know, the state of California also has a lot to do with this, because they want the regions to reduce the amount of vehicle miles that are traveled in greenhouse gas emissions. And to do that, we need to move housing closer to where the jobs are. So there's a lot of political forces also that are moving us in that direction. If you're going to densify to the areas to a point where we can build the amount of housing we need, the problem is if we don't build enough housing, it impacts everybody, because you don't have an ability to move either to a new house, because vacancy rates are so low. So if you want to have a healthy housing market where prices are reasonable and people can move closer to their jobs, we have to build units. And if you look at the densities that are required to make that happen, they're going to be much higher, and they're going to be built around what are called transit priority areas, and some of those are places like where the trolleys are going to stop. The region's investing $2 billion in a new trolley that goes from downtown San Diego up to UCSD, and it has several trolley stops. One is right down here in Tecolote, and then there's another one in Balboa. Well, both of those areas would be prime areas to put high-density housing and be able to use an alternate form of transportation to get to work, either up into the UCSD area, Serrano Valley, or downtown, which are two of our major employment centers. So you have to have the height limits raised if you're going to build denser housing. So that's something that we've been able to enjoy for the last 30 or 40 years. I don't know that we can continue to do that around these high transit areas. I think part of what the mayor said also, though, that it doesn't include all of the coastal areas. So we're still trying to protect some of those view corridors. So does that answer your question?
A little bit. Well, you know, so basically, like almost about 2 years ago, I wrote a story that was sort of a London Mayor advisors had done a report. And it kind of looked at, okay, so the city of San Diego from like 1995 to like 2015 had built like 41% of the housing for the entire county. Whereas places that were adding a lot of jobs like Poway were building like 1%. And the report actually, this is 2 years ago, but it was actually predicting, probably not as good as Sandig, but sort of predicting that almost like people would be living downtown and commuting up to work in North County, because we're seeing so much development happening downtown, but there's a lot of huge projects being shut down in North County. So I guess when I heard the mayor's announcement, I kind of just, I'm trying to figure out, I know it's probably a step in the right direction, but what good is it if you can't get like Oceanside to build more housing, or you know, something like that? So that's more my question, but.
Okay, well, so in that sense too, the state of California, through some legislation recently, has started to become more involved in in how many housing units are built in these different jurisdictions. And so it's part of the regional housing needs assessment. It's called RENA. And the jurisdictions, these other smaller jurisdictions, are being given larger numbers in terms of the housing units that they have to provide. So I think you're going to see pressure from the state of California to have other areas built out also. But San Diego is much more progressive right now than some of the smaller cities in terms of figuring out how they're going to solve this problem.
All right, excellent. Ryan, would you like to comment?
I think less on the specifics of the planning aspect of that, because obviously the expert on that's to the right of me, but I think there's, you know, one thing that's always on my mind as I hear these discussions is just that, you know, underneath the planning aspect of it is I can draw a straight line through population and say we're going to have this many people and therefore we need this many housing units, is that, you know, this is all kind of underlied by homes are built by private developers and they're purchased by individual people who are buying whatever kind of housing unit fits their needs of them and their family at that time based on how much they can pay, where they want to live, where they want to go to school, and so on. And so I think the, you know, one of the issues I always have is just the, you know, and I think that that London report that you're referring to kind of raises this specter of, you know, if we're going through based on regulations and whatnot, it's only profitable to build a house that only 15% of people in San Diego can afford to buy, that the end of that spectrum from less the planning perspective, but more just that's kind of the way the market is dealing with these regulations and these planning goals, is that, you know, we end up as Santa Barbara, which is that there's a lot of very, very nice places for very, very rich people to live, but the median people who fuel our economic growth can't live here anymore, and they move away or don't come here at all, and then we are a very, very lovely coastal community that people like to visit, and we're not at all the San Diego that we are today and want to be in the future. So I just think that, you know, that idea of how do we build housing that's the kind of things that people want to buy. You know, we sort of say, well, if we build the transit and we build the dense housing in this place, it'll all work out. And I think that's always a leap that you know, everybody I talk to is a little bit, you know, as Californians, we're just a little dubious of transit and dense housing and things like that are taken for granted by anybody who's lived on the East Coast. But, you know, we have I'm going to have a single family home, I'm going to get in my car and I'm going to drive to work, and that's kind of my whole conception of how my life is supposed to work. And changing that psychology at an individual level is one of the things that I'm, you know, concerned about in some of these, you know, remaking into, I think we need to in terms of just environmental impact, emissions and so on, but I think there's a huge individual leap that's going to be very difficult to get buyers and builders to make.
Okay, excellent. So this is sort of similar to last year, but I've got about like 20 questions from the audience and they're all about housing. So sorry, Sarah, but I've got one that I think I'm going to turn into a question that you can answer. Someone just mentioned a recent Wall Street Journal article about the Fed's research report about student loan debt. And the person wanted to know how that's impacting the housing market. Not great. I tried to buy a condo last year. I have a ton of student loan debt. I went to NYU. Just wanted to let you know where I got my degree. Anyways, so for Sarah, like, you know, it's talking about the impact student loan debt has on the housing market, but I'm wondering what impact this student loan debt sort of has on the economy and the workforce. Is that a problem that a lot of people are dealing with? You hear from?
Yeah. Hello. Okay. Yeah, that's real, and I can't say that student loan debt has an impact on the workforce in such a way, in that the fact that I have debt is really motivating me to make more money. So that's a positive effect, where we have more people wanting and needing to work. But it is a barrier when people need to take out loans and can't qualify for them. And so it restricts the number of people who are able to enter our labor market qualified to fill the jobs that we have. And so that's why we're piloting this ISA program, which has been done in universities before. Purdue is one that's been doing ISAs for undergraduate degrees. Ours is, as far as we know, the first of its kind in that we are looking at short-term certificates. We are providing wraparound services to help overcome individual barriers as they're going through that education. But I would say it serves mostly as a barrier.
I guess I can put on my educator hat here a little bit. I think, so first of all, I think the household formation, home buying, the student loan debt is pushing a lot of that. You know, you normally kind of have this this clock that was the way it worked for you of, you know, I rent until this period and then, you know, I get married and I have a kid, and you kind of just have a progression of what life stage that happens at. And student loan seems to be adding 5, 10 years onto all of those numbers for the old timers looking back at what's going on with the current generation. But I think, you know, one of the things that that is a big issue is that we invest so much just in the bachelor's degree as the golden ticket to a good life. And it's not as simple as that. You know, the bachelor's degree is an imperfect signal that you have a certain combination of native intelligence and skills and particular things that you've learned while you were in college. But, you know, you have to be, I spend a lot of time with students who are currently making this investment in their future. You know, and I tell them you have to think a little bit more about specific skill set. You have to be an informed consumer about what kind of institution you're getting your degree from, what particular skill set you're going to come out with. And so a lot of that is, I think, that we have done some students some disservice just to say, just get a bachelor's degree. You know, maybe you have to mail in some Cracker Jack boxes, tops, to get it from some for-profit university or things like that, but you have to be a little bit more, yeah, you can tell who signs my paycheck, I'm sorry. But that, you know, a bachelor's degree in and of itself, you have to look a lot more carefully at what are you getting from that bachelor's degree and how is that gonna, you know, on the one hand, here's the debt you're taking out, on the other hand, here's the, you know, again, the combination of skills and the portfolio that you're entering the labor market with. And that is a very, very tough decision. And what we're seeing is that some occupations now are saying, you know, I think I'd be curious to hear your view on this. I think you're a lot closer to this than I am. But I think we're encountering more firms that are telling us that, you know, I just want, give me a smart person, and I don't know what you guys are doing with them, but let me train them instead. So we're starting to see a little bit more, I think, of that. I'll take an entry-level worker and just train them up myself, and maybe they don't need to have that student debt anymore for a particular kind of job, and a certificate or something like that is more in demand.
Yeah, and that is true. We are hearing that a lot as well. And I think a lot of how what troubles me about talking about the four-year degree so much is it's discussed, I also have a background in education, and it's discussed as the end goal. It's you're going to school so that you can get into a college. And the conversation about career needs to come back into it. Well, why are you going to college? What is college going to get you? And is college the right path? So that's another really important part of it. And if you remember some of the occupations we were looking at that were saying they required a bachelor's degree, well, yes, there's a high correlation with bachelor's degree and higher income, and that's why we're pushing people that way. But remember, the employers in the survey were saying for a lot of those, maybe half of them were saying we want a bachelor's degree, but half were saying, no, we want a certificate. We want to know that this person is specialized in the thing I need them to do. So being open and understanding where those opportunities are and educating employers about that too, that bachelor's degree isn't the only signal of quality in a job seeker.
Okay, we have a specific question for Ray Major. Do you think greenfield development in the backcountry should be opened up to address housing shortage?
I don't know that the current political climate would allow greenfield development in the backcountry. There is only one area that we can really do greenfield development right now, and that's kind of down in the Chula Vista area around Otay Lakes. That's the last bastion for greenfield development. It doesn't help meet any of the greenhouse gas goals or the vehicle miles traveled goals, which we have that are set or mandated from the state of California. So opening it up would probably be contradictory to what the overall goals are of the region, which is to reduce those goals. So I don't think that really opening it up is going to solve the problem.
Got it. This is a question. What percentage of our local population is tied to jobs affected by the federal shutdown? Anybody know?
Don't know.
So I'm not going to answer the specific percentage question, but I would say that it's trickier than just that, right? I could go into the BLS database and tell you how many people work for the federal government here in San Diego County, military versus non-military, and do that. But where it gets tricky is just how interconnected the San Diego economy is, right? For every person that's directly getting a paycheck from the federal government, there's somebody here who makes their living selling things to the federal government, or somebody who provides goods and services to the people who get their paycheck from the federal government. So you know, as one of the things that makes macroeconomics so complicated but yet so interesting to study at the same time is just how one little drop in the, you know, one paycheck missed by these federal workers, the ripple effects that will have, and the ripple effects that those ripple effects have. So I think, on the one hand, San Diego tends to be a little bit more defense-oriented in its federal employment, and those are often, but not always, just ask the Coast Guard, viewed as you know, essential jobs. But I think the underappreciated part of this discussion about the economic effects of the shutdown, you know, are again the contractors and the kind of one step removed, the people who sell goods and services to the people who don't have a paycheck anymore, and that's where I think you're really going to see the economic impact of a continued shutdown.
Yeah, and I'm sure Jesse will add to this as well, but our defense supply chain is deep in San Diego. And so while there are some big contractors that might not necessarily be affected right away because the contracts are already running, the payments have already been made, they're still not getting feedback on projects that they're working on. They might be delayed. And then there's those subcontractors that maybe aren't getting payment.
Our first panelist of the second section is Stephen Maduli-Williams, Community Development Program Manager for the City of San Diego. And he has more than 25 years of direct experience working in economic development, both domestically and internationally. And he's also responsible for the management of the Community Development Division in City of San Diego's Economic Development Department. And he manages an annual $10 million CDBG entitlement program, as well as a newly created 10-year, $215 million reinvestment initiative. So here he is.
So good morning, everyone. So again, I'm Stephen Maduli-Williams, and I manage the city's Community Development Division in the Economic Development Department. And generally speaking, our department is really responsible for investing in San Diego's low and moderate income communities, which is really most of the neighborhoods south of the 8. Roughly, from a census tract standpoint, it's about a third of the city. For me, it's been really exciting work. I'm relatively new to San Diego. I've been here about 4 or 5 years and finally started to get a lay of the land. But it's really fascinating work because we're invested in communities that are underserved and there are a significant amount of needs. The one fascinating thing about a lot of the statistics and metrics we heard today, I think one takeaway for me is that you can take everything you've heard about the unemployment rate, job growth, and wages and discount that about 30% for the neighborhoods that we invest in. It's a different environment. From an affordability standpoint, everything is generally a struggle for a lot of residents in these neighborhoods. So in terms of buying a car, anyone else today goes out and buy a car at 6% interest and, you know, generally pretty happy. In our neighborhoods, it's a lot more challenging. First of all, there's no car dealerships around, so everyone's got to get on the trolley to go either downtown or North County to try to find a car. But it's going to be more expensive for them. Their interest rates are probably going to be much more significant. They're probably going to end up more likely buying a used car, which is probably not going to be of good quality, and they're going to end up probably having challenges getting to work. So it's, you know, life is definitely a bit different. And I think as part of our departmental mandate is really about inspiring and investing in inclusive economic growth. And what we mean by that is that we want to see economic parity. We want to see neighborhoods grow and develop, individuals grow and develop. Sarah made some very good points about workforce development challenges, and we've been a key partner with the Workforce Partnership in terms of investing in not only opportunity youth, which is a big focus of ours, but other kind of workforce development strategies to really generate higher incomes for residents in our LMI neighborhoods, because ultimately it kind of gets back to the whole housing problem, because if you don't make decent wages, you're not going to be able to afford to really live anywhere, and that'll start me off on our presentation today. So today I'm going to talk a little bit about affordable housing and really kind of go into some of the numbers around that. It'll really kind of recap some of the metrics that were pointed out earlier today, but really it'll kind of drill down into what happens in low and moderate income neighborhoods, as well as low-income individuals. I will talk a bit about homelessness and what we've done from an investment standpoint, particularly over the last 2 years. And then lastly, we'll kind of talk a little bit about what are some of the potential solutions. So we talked earlier about the average median income price for a home for sale in San Diego roughly being about $600,000 in 2017 and a little bit more in 2018. The one takeaway for us is that in the low and moderate income communities, particularly in some of the infill developments that are starting to take place, we're starting to see those kind of prices in the affordable communities, which is really kind of shocking. $600,000 for a 30-unit development for sale housing in a neighborhood where typically the average home prices would be about $350,000. So that presents its own set of challenges. In addition to that, you've got, as Ray pointed out, you've got a lot of investors who go into neighborhoods and they're currently buying up a lot of property, primarily for rental purposes, but ultimately what you're seeing is that no housing stock availability for people who are currently living in the neighborhood to either purchase a home because they can't afford it, or rental homes, which also are starting to increase. So in terms of rental, same thing, the dynamic really flows along the same metrics as the rest of the city. We're starting to see significant increases in rental prices across the board. You don't see as much production of rental units in low and moderate income communities, and so that's going to continue to be a challenge. This is a real interesting slide. This just really talks about how the production of our percentage of affordable units versus the rest of the county, and as you can see, the city of San Diego really kind of bears the burden for that. And some of that is, structurally that's happened in the past, and that probably will continue to happen. The other challenges is more broader, and I'll delve into this a little bit later, just around the mechanism that creates affordable housing, not just in San Diego and California, but across the country. In terms of vacancy rates, again, 3% or lower in San Diego, and that is expected to trend the same way in the next several years in terms of rental units. So again, not only are there not only is there a very low vacancy rate for affordable units, but same thing for market units as well. And this is one of my favorite slides because this really talks about the production. So as you can see, over the last 8 years or so, the vast majority of the production of affordable housing units have been for very low and low income individuals. And that's really people who make 30% or below in income, 30% of area minimum income, and 50% of area minimum income. So for instance, in San Diego, the area minimum income for individuals is roughly $45,000 a year. And so 80% of that is the income that's needed to live in an affordable unit. But again, most of the units that have been produced have been for people who make substantially less than that. The one area that's really kind of area of concern for us, and it's been that way for a while, is that there's no production in the moderate area. And the moderate is generally that 80% range. And really, I would say anywhere between 60 to 80% of area AMI is where we just see very, very low production. And I think a lot of that is really attributed to the structure of the low-income housing tax credit program, because that is the key producer of affordable housing in the country. And that some of the regulations associated with that program and the financing associated with it really incentivizes development of projects along specifically for 30% individuals that make 30% of AMI and individuals that make 50% of AMI, but nothing for moderate. You do have cities like New York and Chicago that have used mixed income strategies where you have individuals who pay market rent, who live in the same building with individuals who make 30 and 50% of AMI, and that financing has kind of worked to some degree, but that's still pretty limited. But here in California, most of the housing production has generally been for very low and low income individuals. And again, that's a challenge that we will have to continue with here in San Diego. In terms of what we do and how we've invested, so from a housing perspective, real quick, we probably are going to invest, so the last 2 years we invested about $40 million a year, and then in 2020, probably about another $45 million in a variety of different programs, everything from homelessness, affordable housing, workforce development, community facilities, neighborhood infrastructure, smart cities. Those are all the different things that we do to kind of promote inclusive growth. For today's purposes, we're going to talk specifically about housing, first affordable housing, and then secondly, homelessness. So from an affordable home ownership standpoint, we partnered with the San Diego Housing Commission to generate programs that invest in affordable home ownership. But what we've found is that even though over the last years we've invested about $5 million a year, it is really challenging to move these projects forward because the homes are becoming more expensive and we can only provide so much subsidy. And so over the last year, we've only been only to fund about 48 projects, even though the particular program that we operate with the Housing Commission is always oversubscribed. We will put out a notice of availability, and by 6 months, all those funds will be eventually gone. So, I mean, it's good that there's definitely a demand for that product, but we're limited by the amount of funding that we have available for single-family home ownership. Another area that we invest in is housing preservation, and that's really, for the most part, rehabbing multifamily buildings for low-income home renters. Another area that we've invested in is your traditional multifamily affordable housing units, and today, as of this year, we've invested roughly $14 million on what we call home funds, which has leveraged about another $147 million. And project funds really generates about 428 new units a year. The average cost in San Diego is roughly about $343,000 a year for a unit to create a unit, which is, from California standards, actually pretty good. San Francisco, that number is roughly about $500,000 a unit to create a new unit of housing. So it's a bit daunting, but unfortunately, the cost of doing business in California is a little bit more, and that's just a burden of cost that we'll just have to figure out how to bear. In terms of homelessness, as I pointed out, this is one of the areas that we fund, but I just wanted to talk real quick. I mean, there's many questions and thoughts about what is homelessness, but what I really want to kind of touch base on real quick is who is homeless and what does that really mean? So as we define it, it's a place that's generally a person that doesn't have a place that's fit for human habitation, someone living in an emergency shelter, someone living in taking advantage of a motel voucher program, anyone living in transitional housing, even though that concept is kind of slowly going away. And then lastly, anyone that's been in an institution for 90 days or less and moving from shelter to shelter. The next definition is really about what's chronically homeless, and that's a big chunk of our homeless population. And that is, anyone that is, living in a place not meant for human habitation, again, emergency shelter, someone who's been homeless for 12 months continuously, or 4 episodes in the past 3 years, someone who can be diagnosed with a disability condition, someone who's been exiting an institution of 90 days or less. I also want to talk a little bit about what's been our impact. And again, these numbers are really kind of subject to our investment. There are some other investments that are going on, like the city's 3 bridge shelter programs, which really increase our numbers actually fairly significantly. In terms of homeless services, the number of people that we've been able to serve over the past year, roughly about just over 10,000. and that's been trending that way probably for the last 2 to 3 years. Another program which we also support is a voucher subsidy program with the Housing Commission, and that's roughly about 2,000 people that go into permanent housing, and then another 1,000 people with development vouchers. We also operate what's called the Rapid Rehousing Program, and that is basically we provide support for people who temporarily lose their housing, so we're able to give them a month or two rent, a month's rent, so they can actually find new housing. So they'll lose their housing for some unexplained reason, and they're able to come and get support to get back into housing relatively quickly. And then we have about 700 people that are in what we call transitional housing. In terms of funding, particularly in 2018, it was a really big year for us. We spent about $20 million on homeless facilities, one being the new Smart Hotel, which is under construction today. And the goal there will hopefully, that facility will hopefully house about 86 homeless individuals. The new Navigation Center, we recently purchased that in 2018 as well, and that'll serve as the city's marquee point for navigation for individuals that are homeless and looking for not only permanent supportive housing, but specific services. And then lastly, we spent about $4 million in services for the homeless. And that's actually a really challenging bucket of funds for us, because that is our public service dollars are generally dollars that go to not just homeless activities, but workforce development programs, youth development programs, educational programs. So we're generally fairly limited with that resource. And today, as of today, I would say a significant portion of that goes toward everything from shelter programs, day centers, interim housing, transitional storage. And again, I mentioned rapid rehousing and a new program that we call Safe Parking, which is really structured toward people that are homeless in their cars, and then there's a safe parking lot that they can go to in the evening to not only sleep, but also be safe and not be on the street at night. Generally speaking, our cost per client visit is roughly about $412, which is pretty much the industry average. And then lastly, over in 2018, we made a pretty significant investment of roughly $24 million in just homelessness services and activities and facilities alone. And that represents a really significant increase in the city's investment. And and one thing that one thing the mayor mentioned in his address is that, and then I think this bears out, is that over the last 2 years, the city of San Diego has made a significant investment in homeless, in the 3 buckets of funding that relate to homelessness. You have homeless housing, homeless services, and then lastly, homeless facilities. And I think it's pretty safe to say that over the last 2 years, the city of San Diego has invested at least $50 million in homelessness to address the critical issues that we have. From a services standpoint, as you can see, since 2015, we've really trended up. And 2017, the funding went down just a little bit, as well as the amount of people serviced, but I can tell you in 2018 and 2019, that arrow goes back up. Solution. So as a city right now, we're currently looking at a lot of different options as it relates to how do you address not only affordable housing, but homelessness as a significant component of that. And again, as the mayor pointed out in his State of City address, the first component is innovative land use policy. Without any innovative land use policy, it's going to be difficult to kind of change the structural environment that allows you to create more units of affordable housing. So I think first and foremost, that's the first thing that kind of needs to happen. The second thing that really needs to happen is really kind of more innovative financing strategies, because we talked about this middle moderate sector of the housing bucket that's not being addressed from a development standpoint. And clearly right now you've got the low-income housing tax credit program that addresses the low and moderate, the low and the very low, but there's not a financial vehicle to really kind of address the moderate. And even still, there's a need for more production, even from the low and moderate standpoint as well. One of the big challenges that we were faced with several years ago is really dealing with the loss of redevelopment dollars. the city of San Diego lost roughly somewhere between $175 million to $200 million when you look at 2012 when redevelopment ended to 2017. And there's been no source identified to replace those soft dollars that are associated with affordable housing development, and that's been one of the bigger challenges. I think the good news is that the new governor, Gavin Newsom, is really committed to identifying new resources within the state to promote affordable housing. I think another piece of good news is that we've got a new program called the Opportunity Zone that just got kicked off this year. And what we're seeing and what we're hearing from investors is that the core product for that new investment vehicle will be what we call workforce housing, which is that moderate housing. And some projects are already been, one project in San Diego has already been identified as a workforce housing project, which will bring in investors from Wall Street to really hopefully escalate the amount of development that happens from a moderate housing perspective. And again, right now the two solutions are really based on innovative land use, and number two, coming up with really creative financing mechanisms to really increase the production program for both very low income housing as well as moderate rate income housing. Well, that concludes my presentation, but I'll be more than happy to answer any questions that you might have about housing, affordable housing, and the work that we do. Thank you very much.
All right, thank you very much. Next up, we have Jesse Gipp. He's the Senior Manager of Economic Development for the San Diego Regional Economic Development Corporation. He leads a regional effort known as Operation San Diego to support the region's military economy, which includes 16 bases and related infrastructure. His focus includes advocacy at the local, state, and federal level, as well as direct assistance to defense contractors and military bases across the region.
Good morning, everybody. Thank you for having me here for this great event. It's phenomenal to listen to the expertise that we have within this region, looking at a variety of different issues tackling or coming at our economy in the next couple of years. So I want to talk to you a little bit about our defense industrial base and some of the trends that are impacting the deployments that we see within the region, the spending that's happening here, and some of the things that we can look forward to the future. I want to start with a comment that really I think a lot of the major technology companies and the ecosystems that have been developed in San Diego really over the last 50 years have their roots and origins tied back to the defense industrial base that we have within San Diego, both especially on an aerospace side, but even on a telecommunications side. There's a story that we probably don't tell well enough in San Diego, that Irwin Jacobs, before co-founding Qualcomm, who was a professor at UCSD, was doing naval research with a local entity called SPAWAR. And that research led to the development of CDMA technology, which was one of the core protocols that allowed us to have cell phones. And that was done through research with the Navy that created Linkabit that eventually created Qualcomm. So our largest private employer within this region was developed through military research and innovation. And that's a common story. Viasat, Cubic, General Dynamics, NASCO, and there are many other companies in this region that do dual-use commercial and defense technologies that employ tens of thousands of individuals across this region that have either direct or indirect connections back to our military. All right. So just from the kind of a big picture perspective, when we talk about San Diego, and it's easy, I think, for us to lose sight of really how large the footprint is here, but San Diego is the largest concentration of U.S. military anywhere in the world. Between the Navy presence and the Marine Corps presence, 60% of the Marine Corps combat power exists between Miramar and Camp Pendleton, and a growing majority of the naval footprint deployed in the world is either home-ported in San Diego or is Pacific-facing. And so when we talk about the impact to San Diego, it still remains the largest single impacting cluster to our overall economy. These are some numbers taken from just this year's updated version of the San Diego Military Advisory Council's MEIS. But the direct spending within our regional economy on an annual basis is about $26 billion, which creates about 340,000 jobs in our regional economy, leading to about $22 billion in income and a gross regional product impact of about $50 billion. There's about 110,000 active duty military. That's not counting the civilian population that also works to support that active duty military uniformed personnel. And about half of that is Navy, half of that is Marine Corps. And there are about 57 ships currently home ported here in San Diego. And I'll talk more about those numbers related to the ship count because those numbers are going to be changing over the next couple of years. I know there were some questions about the federal government shutdown, and so just to kind of set it straight, the part on the defense side, there was a 2-year budget deal that was passed that funded DOD through 18 and 19. And that's why, frankly, I don't think that this government shutdown could have happened. It certainly could not have persisted in the way that it has were DOD not funded. Usually that mechanism of pressure that creates around DOD not receiving payment is enough to end most government shutdowns. And so this partial government shutdown that we're going through is in part made possible, frankly, by a budget deal that happened that funded DOD at really record levels in 2018 and 2019. And so the military, most of the major defense contractors who support them are still receiving funding. There are significant impacts to some of the major defense contractors, though, who do other government work, whether that's with DHS or the FAA or other agencies that have been significantly impacted by these shutdowns. And certainly those impacts are being felt locally by our companies and certainly across the country. So I just want to talk a little bit about how this defense spending impacts our overall county. So when you think about the place of performance for work, San Diego is a net receiver of contracts awarded all across the country. So we have money coming into our county that is awarded to firms that might exist in Virginia or in Texas or in other parts of California, but that work is being performed in California, or specifically in San Diego. So when you look on an annual basis in terms of money coming into the region that's awarded to defense companies from across the country, we are about $1.4 to $1.5 billion on an annual basis net receiving in terms of income flows. On top of that, there's about a $5 billion to $10 billion annually of new contracts awarded in the San Diego County, and the vast majority of that, $5 billion of which on an annual basis is going into the city of San Diego, and the rest is dispersed across cities across the county. But the vast majority of funding is being spent within the city of San Diego itself. So really quickly, people ask, I mean, and this is probably no shock to anyone here, but the Navy tends to be located in places that are close to the water. And San Diego happens to have a lot of water. So, but there's more than that, which is why San Diego is strategic for the U.S. military. Over the years, a process called Base Realignment and Closure, referred to as BRAC, has closed military installations across the country, and in particular, some very major naval installations like in locations like San Francisco. So you see there is a consolidation of home port facilities for the U.S. Navy on the West Coast, with San Diego remaining the single largest concentration. Building naval installations and taking coastal property to do that is not something that is easily done. And so it's unlikely for really any foreseeable reason that the Navy would ever decrease its footprint in San Diego, pretty much irrelevant of the geopolitical situation in which we live, because getting that property back is something that I think the federal government and the military and the Navy in particular understand is something that would not be possible. And so that infrastructure that's developed over a time is incredibly valuable. What this crayon chart shows you, this is another reason why San Diego is so strategically important. What those are, those purple boxes are naval ranges, and those orange lines are dedicated, restricted military airspace. From San Diego, they have access to training ranges both at sea and over land that exist really nowhere else in the country. And so being able to do real training missions that coordinate between the Marine Corps, the Air Force, and the Navy can be done from San Diego unlike anywhere else in the country. And for those reasons and our position on the Pacific Coast, San Diego remains an incredibly vital asset to the U.S. military. And that was made particularly clear in the Obama administration with a strategy known as the Rebalance to the Pacific, initially called the Pivot to the Pacific. Some of the folks who are not in the Pacific thought that that was a bad thing, so we called it a rebalance. But really, we're shifting more and more of our focus to the Pacific Ocean. Most of the world's international trade flows through the Pacific Ocean. Certainly our peer-to-peer competitors in Asia remain a major focus point, and certainly the activity around North Korea continues to be a focus for the U.S. Navy. And so for all of those reasons, the Pacific is incredibly important, and therefore San Diego is incredibly important. Here's some of the impacts that we're going to be seeing from the rebalance of the Pacific directly to San Diego over the next couple of years. So we're currently at 57 ships home ported. We're expected to be up to 77 by 2025, and that's going to add about another 15,000 Navy personnel. And there's a variety of ways in which that impacts our economy, both positively and negatively, frankly, in terms of some of the impacts and some of the pressures, especially on the housing side that I'll get to in a minute. And there are a lot of similarities with some of the challenges that our military are dealing with in finding appropriate housing for the sailors and Marines who live within our communities, who are regularly having to commute further and further out from the installations in which they work in order to stay in Southern California. And that remains part of our overall housing structure that we have to think about when we look at our community moving forward. But I'll say these numbers, this projection is based off a target goal for the US Navy at about 305 ships. The Trump administration and the Navy in the last couple of years has said that what they really want to be at is a 355 ship Navy. If that budget becomes a reality, which it's not clear that it will, frankly, it's probably unlikely that it will, those numbers would be way off, and we would see those numbers grow even further. And then the economic impact would certainly increase, but also the number of ships and the number of personnel would dramatically increase within the region over the next couple of years. But the numbers that you see here are things based off existing ship creation and shipbuilding that is already underway, that has already been planned and budgeted for, and frankly will happen. So when we think about how San Diego stacks up relative to the other places in the country that are kind of defense and innovation hubs, San Diego County receives the second most defense funding of any county in the country outside of Fairfax, Virginia. And Fairfax has a slight competitive advantage of being fairly closely located to a 5-sided building that spends a lot of money. But outside of the Beltway, San Diego by far and away receives more defense spending than any other part of the country. And we don't see that trend changing for any particular reason. And frankly, it's an opportunity for our economy in that we do have some resiliency built into our economy with consistent defense spending. We don't want to be an economy that's a one-trick pony in any industry, and we certainly don't want to be an economy that booms in wartime and then collapses in peacetime. But when we think about what the defense spending does for technology development and for a stabilizing effect to our economy, there are benefits that we certainly get to capitalize on within this region that are unique to us, and they're tied back to some of those strategic strengths that really nowhere else in the country could duplicate even if they tried. So I'll talk a little bit about, some of this research came from a report that we did as part of a bigger effort with the city of San Diego in the last couple of years to better understand our supply chain within the region. But we'll talk about some of the procurement trends. So these are new contracts being awarded to San Diego County firms in that given year. There's more money being spent on an annual basis, but this is just new contracts awarded to firms. And one thing I want to point out here is how much fluctuation you see in this chart from a high point in 2012 of $11.5 billion in new contracts to $9.2 billion in the 2017 number. Defense, because of the nature of the political beast in which it lives within, can be pretty, I'll say random in the allocation of funds. And so there are major acquisition programs that get deleted. There are major acquisition programs that change dramatically. And sometimes those reasons are very political. And those impacts can have very major impacts on our region. And you can see here, just in the number of fluctuations that we have in a very short period of time, that 5-year spread in the amount of contracts that are coming into the region. So that is a dynamic that defense contractors have to deal with, is that their funding stream, although relatively consistent in that the checks are being paid, how contracts and how programs and major acquisition programs are developed and funded can change fairly quickly based off the political whims of Congress at the time. And when we look specifically at San Diego, this little drone chart, what it's really showing you is, on the top portion there, is the percent of our defense firms, which we think there's about 5,600 firms in San Diego County that are doing defense-specific work. About 37% of them are doing professional, scientific, and technical services. That ranges from R&D, life sciences, biotech, software, machine learning, artificial intelligence, cybersecurity, all the things that fall into PST. And then about another 24%, the second largest concentration of defense firms, are doing manufacturing. And then the second two numbers there, the 16 and 65%, are showing of our defense-specific jobs where they're concentrated between those two groups. So while we have more firms doing professional and scientific work, the employment concentration is significantly lower relative to the manufacturing, where 65% of those who are in our defense sector are working for someone who is doing manufacturing. And that's really driven by our shipbuilding industries and our aerospace industries in particular, which are increasingly concentrated in San Diego around robotics and unmanned systems with General Atomics and Northrop Grumman. And those, we don't see any sign of that particular portion of our manufacturing sector having any decline. The shipbuilding assets that are here are really fairly irreplaceable. And the research and the manufacturing that's being done on the robotics and unmanned system side is really a long-term trend for DoD to pivot towards robotics technology in general. And again, this chart is just showing San Diego's manufacturing employment over a period of time relative to the United States. And you can see that we have actually been growing in our manufacturing employment, where the country overall is continually declining in manufacturing employment. And that really has to do with the type of manufacturing that we're doing here in San Diego. These are not the type of manufacturing jobs that are most pressurized by either globalization or automation. These are jobs that are in very high-tech industries already, where these manufacturing facilities are using a lot of robotic applications from the get-go, and they tend to not necessarily be jobs that are aerospace engineers or mechanical engineers. They can be technical jobs that don't necessarily require a degree, but they're still a little bit more stable, and so we're seeing that growth continue. Also, when we talk about our San Diego defense ecosystem, there are a lot of big companies that people kind of frequently think of: Northrop Grumman, General Atomics, Boeing, General Dynamics, NASSCO, Cubic, Viasat, and others. But really, when you think about the number of firms within our region, over 90% of our firms are what we would consider to be small businesses, with 50 or about 80% have less than 50 employees. So this is a small business economy on the defense side. And so when we think about programs that we're trying to develop as a regional economy to support businesses, although Cubic and the larger companies within the region certainly attract the headlines and receive major contracts, they have subcontractors in a supply chain that are supported by predominantly small businesses. And the things that impact small businesses on a cost perspective, housing, transportation, all of those things that are regional issues impact those companies in a very real way, and need to be things that we're thinking about as we continue to support the growth of our defense ecosystem. So just talking a little about some of the headwinds and just kind of some of the trends. So right now, we're actually, despite the fact that this FY19 budget for DoD is one of the largest that we've ever passed in U.S. history, DoD spending relative to GDP is at some historic lows, right around the 3% mark. And if you think back to, even during the kind of the Reagan buildup, we were much higher in the 20% range and higher, and then back even further, certainly the high point was during World War II. And so that's to show that, while DoD spending as a whole number is certainly grown, we aren't necessarily spending well beyond the means that we have done historically within our GDP. And I think that that's something we need to keep in mind while we have these big headline DoD spending numbers, that when we think historically about how much we're really spending on GDP as a percentage of GDP, how complex the mission is that we're asking for our U.S. service members to perform, that really we're probably paying for something that is the value that we hope to be getting. I also want to mention, so the Navy right now is less than half the size that it was in 1989. At the peak during the Cold War era, we had about 685 deployed vessels, and right now we're about 285. And that mission hasn't changed much. We're still asking those ships to be deployed in multiple oceans around the world on regular rotations, and what that means is the op tempo for the sailors is increasing, so you're seeing more burnout among the Navy personnel who are having deployed more regularly for more longer period of times. You also might have read more recently about some unfortunate tragedies that took place with some accidents in the South China Sea and in nearby areas, with accidents, with collisions with U.S. naval vessels and commercial vessels. And really, some pretty scathing reports came out about those, and some of them dealt with really just a lack of training and burnout among both leadership on those ships and the personnel who are operating them. So when we think about the mission that we're asking of our sailors, how regularly they're being deployed to do complex things around the world, and how much of a role they're playing in our foreign policy, thinking about the size of our Navy and how that impacts both the equipment and the people at this current level is something that I think is a long-term issue for us to deal with. And then lastly, just for DoD budgets, personnel costs as a percentage are growing increasingly across the board. And that eats into ship maintenance accounts, that eats into money that would be spent on infrastructure on the shore side. It eats into the money that would be invested in R&D and in new technologies. And so as we think about how we're going to continue to pay for the workforce that are the volunteers who are giving themselves up in service for our country, we also have to recognize what that is doing to compress some of the other investments that DoD typically makes in investment in technology. So there's some major opportunities for San Diego, and I'll touch on these very briefly. For those of you who have ever driven down the 5, you probably have seen this building, although maybe not from that angle. And if you don't know the story of what that building is or was, it was built in the 1950s or 1940s as a B-24 production facility for World War II. This is kind of a classic Rosie the Riveter facility, predominantly employed about 35,000 women who were manufacturing B-24s that would be steel delivered on one end, and B-24s would come out the other end, fly off from Lindbergh directly to Hawaii, where the U.S. Air Force would then fly it out into the Pacific Theater. Right now, that building is being used by one of the Navy's premier cybersecurity entities. Not exactly a building designed to purpose. And SPAWAR, if you have been reading in the news, is looking to get new facilities for themselves and leverage the fact that they have about 75 acres of land right there on the doorstep of downtown San Diego as an investment asset to the broader community and do a public-private deal with the city and with developers to get them a new building more adequate to the mission that they are pursuing and potentially address some of the housing concerns in that area and build commercial Class A, residential, and retail around that. And it's a big opportunity. SPAWAR employs about 5,000 people at that facility that are primarily technical. And so keeping that workforce in a building that's more suitable to their needs is a huge win for the region, but it also represents a great opportunity for San Diego to think creatively about how we leverage federal military land to solve development issues in our own backyard. Additionally, smart basing installations themselves are small cities, and we've got more than 16 across San Diego County. Those bases are increasingly becoming more open to becoming test beds for a variety of different kind of smart city IoT technologies, ranging from autonomous vehicles, of which Miramar is currently partnered with Qualcomm and Volvo and others, to use an autonomous vehicle circular to move Marines around the base. But they're also looking at robotics, drones, other IoT sensors for managing their facilities. And that's a real opportunity for technology companies in this region to be thinking more creatively about how we partner with those bases as an asset to develop and invest in new technology. And then tech transfer, an ongoing theme for our economy, but there are ways in which we can continue to accelerate the advancement of tech transfer as opposed to having it just happen spontaneously. There are institutions at UCSD that are working hard with SPAWAR and other research enterprises in the region to move technology out of the Navy and into commercial enterprises, but I think there's more that we can do there. Now, housing, this is both a challenge and an opportunity, but as I said, the military does have quite a bit of land in the region, although it's, for the most part, being maximized to the max for a very military-specific purpose. They have their own housing needs. With those 15,000 new sailors that are going to be coming in by 2025 alone, they need to find places for those people to live, and oftentimes it's not going to be on a military base. The vast majority of military personnel in our community do not live on a military base. They live amongst us. And so these housing pressures that we talk about are acutely felt by those folks who are often now living in places like Temecula and driving from Temecula to downtown San Diego on a daily basis. So working with the military as another partner in how we talk about housing and think about what the long-term needs are for our community will be critical as we address that, both for our residents and certainly for the military. And then lastly, shipbuilding. Whether we go to a 355 ship Navy or we go to a 305 ship Navy, the manufacturing that is done here for shipbuilding is really world-class. GD NASSCO is the only full-service shipyard anywhere on the West Coast, meaning that they build ocean-faring vessels from steel all the way to the end of the process. They're the only yard on the West Coast that does that work. And they employ a class of workers who then take on their technical skills, which are welding, pipe fitting, a variety of other skills, and can apply those to steel trades, oil and gas, and a variety of other areas. So that is also a place for us to generate really well-paying blue-collar jobs within our region and where those jobs are being crunched. And so that's an opportunity for us to continue to develop a workforce there around that function. So lastly, predictions for 2019. DoD budgets are going to come down. They're at a high point right now. They will not stay that way. They will certainly come back down closer to probably President Obama-era levels in FY 2020, depending on how things negotiate between a Democratic-controlled House and the Senate, although frankly, looking at how good negotiations are going these days in DC, I'm not particularly optimistic, so I think we might move back into an era of continued resolutions and CRs where we're basically passing these stopgap measures that fund the government at pre-existing levels. It's a painful process for everyone to go through. It does not allow for innovation. It does not allow for new contracting, and it certainly wastes a lot of very talented government officials' time, both on the DoD side and other agencies' time, just figuring out the accounting mechanics of absorbing that technical problem and not focused on the job that we hope they're all doing. geopolitical events will continue to incentivize growth in San Diego. The Pacific isn't getting any less important, and that will remain a constant, not just for the next 5 years, but for the next 50 years. And so as we think about both the diplomatic and the military elements of how we engage in the Pacific, San Diego will continue to be a launching point for those endeavors, and so investment will continue to move to San Diego. And then lastly, robotics, communications, shipbuilding, and cybersecurity will lead DoD employment within our region. Those are technology areas that are cross-cutting a variety of different sectors, not just the Navy, it's the Air Force, it's the Army. And we have a lot of strengths because of great universities like USD, UCSD, and SDSU developing robotics and communications technologies. And we're going to continue to be a place that benefits from that synergy between a commercial industry that's rapidly growing, where there is consumer demand, where they can innovate products more rapidly, and then also have an R&D budget from the Defense Department in those areas. And so I see those continuing to grow, even if defense budgets overall are coming down. And with that, happy to answer any of your questions. Thank you.
All right, thank you. So now we're going to begin our discussion portion of the presentations. And this one, we can start with Stephen, maybe. This is, you know, a lot of times when I write economy stories and we talk about tourism, it's almost like not seen as that important because the jobs are very low wage and, you know, it's not something we should emphasize, sort of this idea. So this question says, how does tourism play a role and in the convention center expansion to job growth and economic growth?
Well, I think the important thing to think about is the workforce, meaning that from a tourism growth standpoint, do we have the workforce that has the ability to supply the tourism industry? And I think the answer to that question is yes, possibly. One trend that we've started to see, and I think Sarah could probably answer this question a bit better than I, is that there are definitely workforce development programs that are propping up, and I know we invest in several of them that really focus on the tourism and hospitality industry. For instance, I'll give you an example. We have an organization that we fund called Kitchens for Good, and primarily what they do is they train low-income individuals to develop culinary skills so they can eventually go out and work in a restaurant or a hotel or something like that. And what you find is that a lot of individuals in the workforce that we target, really, there are no restaurants in their neighborhood, so they can't actually get experience, you know, bussing a table or manning the front counter or basic culinary skills. And so we think that what happens is that we're able to generate local workforce to supply the industry in such a way that it continues to remain robust throughout San Diego.
Yeah, and I'll add to that. A lot of the tourism industry is the low-income jobs that we were talking about earlier. And that's a struggle, has been a struggle for us, honestly, as an organization, because we want to make sure that we're helping people to progress in their careers and get self-sufficient wages. And what we're starting to do is do more research around what are the pathways within retail and tourism and hospitality, what are the pathways that are natural when you sort of hit this pyramid of there's a huge base of you know, people who are doing serving jobs or busing jobs, and then management gets really narrow really fast. Or where else can they go? What have their skills prepared them to progress in their career? So helping to create those pathways, I think, serves both what we need as an economy and helps people to keep moving through those careers so that they're able to have self-sufficient wages.
And lastly, one of the unseen barriers is really transportation. So, for instance, if you have an individual that lives in the Encanto neighborhood, one, they'll need to be trained, but number two, they'll need to be able to get to a hotel. And fortunately, we have the trolley where individuals now can actually get on the trolley and get to Mission Valley or downtown. But that's been, and that still is one of the bigger barriers that we have in the neighborhoods in terms of people accessing workforce development or job opportunities.
Okay, so this question is headlined San Diego Homeless Solution. So we've done it. Maybe, geez, I'm not sure who's best to start with this one. Maybe Ryan, maybe. Okay, so the question says, Would the city consider reallocating the $14 million budget towards acquiring and providing tiny homes to place in city-owned parking lots or infill areas? This person says the cost for a tiny home is $30,000 to $50,000. What do you think about that?
My only expertise on this is that my wife occasionally watches that show. That's really all I can contribute to this. I don't know the zoning particulars of where those can go or any of that.
Maybe that would be Steve.
Yeah, I mean, the biggest challenge with tiny homes right now is just it's one thing to spend $30,000 for a home, but you've also got to build the infrastructure. You got to build the community. So I think what we probably need to see is a couple pilots to see what actually works and what infrastructure is really necessary to support tiny homes. I mean, you've also got the notion of having micro units, which is probably something a little bit more implementable at this stage than creating a community of tiny homes, but it's certainly something that's on the table.
And
It's just a really small apartment that's about 100 to 200 square feet per room.
New York size.
New York, yeah.
Yeah.
And San Francisco has some market rate micro units that are been developed, but it's basically one of the new strategies to increase density and provide more affordable units.
Oh, sorry, Sarah, were you going to say something? Or?
it was more of a wondering of how big tiny homes get, because we know an individual or two could live in that kind of space, but we also have families with multiple generations or extended families living in small spaces right now. A lot of the people who are in need of homes. So I could see it as a solution to part of the problem, but certainly not the whole problem.
Okay, so this question is kind of goes into military a little bit, and so we could start with you if that's cool. So this is sort of, I was the Port of San Diego reporter for about 6 months, and this sort of fits into that, which is sort of almost a tension going on. But what kind of incentives do we expect to bridge the communities like National City to maritime DoD funds?
So I guess we'll start with, a lot of the shipbuilding workforce live in those communities, and if not, a lot of the companies are actually based there. I don't have the specific numbers, but we did SDMAC did a shipbuilding study a few years ago, and they're going to do another one update to it. But if you look at the supply chain for the shipbuilders, a lot of those companies are certainly right around them in the Barrio Logan communities, and then further south, both in Chula Vista and National City. And those companies are, manufacturing or are building a lot of raw materials that are part of the manufacturing process for the shipbuilding industry. And I think, so from an industry and a kind of an opportunity perspective, there's probably quite a bit of connectivity already there. There certainly could be more, because those are good, consistent, stable jobs to build around. I think there is an element of communications that was part of kind of the Prop B fight around, that happened a few years ago, for those of you who are tracking, about kind of zoning near the shipbuilding industry, that a lot of the shipbuilding industry thought really would kind of in the long run threaten their viability to exist. And it was also sort of a national security argument from the Navy that if those shipbuilders went away, their ability to repair and maintain Navy vessels in San Diego would be, in the long term, would be very damaged. So there's a balance there to have a conversation with those communities who have historically been living very close to those shipyards, who have been there just about as long as those communities, to make sure that those industries are integrated together, and then they talk about local solutions from a political standpoint.
Awesome. Yeah, I know I did a story about Pasha Automotive down there a little while ago, and I was able to talk to some employees that basically had, just all of them lived in National City, so it's kind of a disconnect. Okay, so this question is about opportunity youth, which I believe, if I'm right, that's sort of the industry term for people that aren't working or going to school. Is that right? Okay.
Yes.
So, okay, maybe we'll start with Sarah on this one. My school works with opportunity youth, and we have seen an increase in homelessness due to the deportation of our students' parents and family members. Getting a little political here. What impact do you see that immigration issues have on the San Diego economy?
That's not even political, that's just a fact.
Yeah.
Right? Our our families are struggling, our children are struggling because they're losing their families. I think, so it was, sorry, the effect of the border in general, or what on the San Diego economy?
It says, what impact do you see that immigration issues have on the San Diego economy? And the first part of the question was, they've seen an increase in homelessness due to the deportation of our students' parents and family members.
So there's the workforce in general, right? Where you saw the chart where we have apparently 100,000 open positions and only 50,000 people looking for jobs. And if we are to close that gap, to me, there's an impact when immigration is being limited, when we have great talent in our neighbors that we could be leveraging and bringing, even if not for people to be moving to San Diego, people to be commuting from Tijuana, which people do on a daily basis who have the work authorizations. So it's troubling to me to hear lots of anti-immigration rhetoric because of that. I'm going to get the stat wrong, but just as an example, I'm going to get the stat wrong, but let's just say Mexico produces a lot of engineers. And I don't remember exactly how many, what the percentage, but a ton of engineers, and limiting that workforce that may be able to contribute to us as well. It's troubling. That's all.
All right, so this question is for all our panelists. Maybe we could start with Ray Major on the end. And the person wants to know, if you weren't part of this event last year, maybe just sort of what surprised you based on what you thought at the start of last year, but says, can each of the panelists tell us how they did with their predictions from last year's Economic Roundtable? So, Ray, could we start with you?
I think I did really well with my predictions because I didn't commit to anything, just like I'm not committing to anything now either because I'm an economist. So, last year I think they asked the question, when would there be a recession? And I think that we said something that it would be in about 2020. I think we're still kind of on track for that. So, yeah, I've been real happy with myself. I had a good year.
For me, I would say the thing that surprised me a little bit was a lot of the same things that I was referencing this time were kind of on my mind maybe a year and a half ago. And as I alluded to in the presentation a little bit, I think that we kind of got a little bit of an extra boost from the tax cut that was maybe a little bigger than I was that I was originally thinking it would be. So that's kind of led me to I felt like many of the things that I was saying, I'm going to watch the yield curve a little bit. Well, I was saying that last time too, and it's moved in the direction I thought it would, maybe not as far as predicting long-term interest rates in the United States is one of the places where you're going to be most wrong most often, frankly. Even the federal government has we've been failing at it for 30 years about predicting what the borrowing costs of the federal government are going to be. But yeah, so I think if anything that the kind of late end of this expansion has had a little more legs than I thought it would.
I think a lot of my prediction last year was around the growth of apprenticeships. You can see I've got a theme. And it has been moving in that direction. There's been a huge investments coming down from the community colleges to fund creating apprenticeship programs and partnerships with local businesses. There's a lot of conversations, though, that are still in the works or with the Department of Apprenticeship Services for California around how they define apprenticeships and how to do that in such a way that we can be innovative and create models that are going to work for our current economy and not necessarily how we've talked about them historically.
Great. So my projections were really, actually, I would say pretty exceeded in the sense that I've been really heartened by the speed and the level of commitment that the city has made to really addressing homelessness and being really creative about land use, which is obviously fairly critical, but also being creative as it relates to addressing homelessness.
Like Ray, but for different reasons, since I didn't participate last year, I think I get a gold star for nailing the predictions I didn't make. So I guess you'll just have to judge me based off of those for next year.
All right, well, I'm sure you would have been on top of it if you did talk.
Yeah, I feel that way.
Yeah. So I've been getting a lot of housing questions, and even though I feel they're maybe could be a little redundant, I also feel bad about not sharing them. But one of the themes involves building more in the outskirts of San Diego County. And, you know, one person asks, they really wanted some more housing around several of the casinos like Valley View and some of the other ones I've never been to. And there's another one that cites a report that says coastal California is, you know, just too high. And this report kind of looked at like outlying issues not addressing the demand. And this is why like a general plan in the urban core really isn't going to work. I guess, is there maybe people that didn't talk before or anything else we could say about like, I'll put it this way. So I moved to San Diego like 3.5 years ago, and I always hear all the time about how we don't have any space for housing. But when you look at San Diego from space, it looks like there's a ton of housing. Especially, I mean, a ton of space. I mean, if you don't mind living in a mountain or the desert, but just let's say you're really new to San Diego. Could someone really explain, like, really simply why we can't build in all these areas past like Alpine East? I'm kind of confused. Yeah.
Before you answer it, I'll just say, you know, when we talk to employers, this is also a quality of life issue, right? So yeah, you could build housing 100 miles east of San Diego, and then those people are gonna have to drive 100 miles to a job. So are they gonna wanna do that? Like, it could be really affordable, but like right now, like the pressures that you see on people and the further and further they're having to commute, that's time away from their family. That's more in childcare costs. Like there are additional costs created when the job is exponentially further from where you live. And so there are certain people and in certain circumstances where you're gonna wanna live from certain job centers. But if those maps hold true that, you know, we show about where the kind of job centers are gonna be in our community over time, they're not dramatically changing. You're not seeing a huge blow up in jobs being created in the El Cajon Valley or in some of those areas that might make it closer to make Alpine a reasonable expansion. And if that's not the case, then who's going to really go live there if their job is in Mission Valley or in Kearney Mesa or in UTC or on the border? You know, there's a lot of movement that takes place there, and there are real costs associated with the time. Even if we have the best transit ever built over the next 10 years, there's still that time to travel that'll be a real impact on any person's decision on where they want to live.
You know, I'd like to echo that. Moving here from San Francisco, obviously there are land challenges as well. And what you started to see over the past several years is a lot of people left San Francisco and Oakland and moved to Richmond and some of the further suburbs. And the challenge is further cities. But the bigger challenge is transportation. Everyone started to have 1 hour, 2 hour, 2.5 hour commutes every day from Livermore, from San Jose, just to get to work. And what we started to see when I was there was a lot of bitterness in terms of the quality of life, in terms of people having to, you know, have the kid get up at 4 o'clock in the morning to get to school in San Francisco. Maybe they worked in the city somewhere just to drop them off at daycare. And so it presents some, the notion of outlying housing in outer areas presents some serious transportation challenges. And you can imagine what the 8 would look like if you have 2,000 to 3,000 more units of housing. And again, I used to go to 580 all the time. I just got back from Livermore, and it took me 2 hours and 15 minutes to get to Livermore, from Livermore into San Francisco during the holidays.
That's amazing. Yeah, I did a story about a month ago about commuters from Tijuana, and I met some guy at his house, and we went all the way from there in Mexico to his job in Balboa Park, and it took about 1 hour and 15 minutes. So that's pretty horrible for San Francisco. Maybe on that related topic, I know I recently moved to Chula Vista, and a lot of my neighbors have asked me about this, but as far as people living further and further away, we've kind of noticed that the trolley doesn't go to like the Otay Ranch area where there's a ton of new housing going on. And I asked a developer about it recently, and he was kind of like, yeah, isn't it funny how the trolley just keeps going north? And I guess the implication was there's more affluent people the further north you get, I guess, whereas in Chula Vista, you know, the income might be less. Maybe, Ray, you could shine some light on that. Why doesn't, like, the trolley kind of go to where we're building a lot of housing for maybe lower income?
Well, you know, the trolley is an exceedingly expensive infrastructure to put in, especially in places where there already is, you know, something else that's built. The trolley extension that we're working on now has been in the plans for 30 years. I mean, this is not something that happened overnight, and it'll be open in 2022. These are very long-range projects. So, you know, this particular part of the trolley, you can say, is going to an affluent area, but with the inception of the whole Transnet half-cent sales tax back in the 80s, the first trolleys that were built from downtown down to Chula Vista and out towards East County. So those were built first. This extension does go up to UCSD, but part of the goal there is to tie the 3 universities together too with some of the employment centers. So it was an important piece of infrastructure. The next trolley that is being thought of or planned, it's out of ways, would be called the Purple Line, and it would be the alignment would be along kind of the 805 going up from Chula Vista to Kearny Mesa to get the people that direction. But these things are expensive. I mean, the estimates are probably $5-6 billion to put something like that in, and so a lot of this has to do with economic trade-offs. And so in Chula Vista, for instance, the easier, faster way to do it is to do some type of BRT or some type of transit, that like a bus that would take people to the trolley stop. So I don't know that that's necessarily 100% true. I can see why people would perceive that to be the case because of the current line that we're building. But in the overall plan, you know, when Sandag looks at where to put infrastructure, we look at communities of concern. We look at where the aging population is and where the people with less income are, those that are transportationally challenged, and we're looking to solve that problem too.
Okay, and I was wondering, this could be more for the whole panel, anybody that would like to talk, but it kind of goes to another question we have, and it's sort of wanting to know, with your work with businesses or maybe some of your employees that might work for you or students, where are they coming from? Where do you keep hearing? I know all of us probably have coworkers in our office that commute from TJ. It just seems to be getting further from those job centers. So where are you hearing in your personal interactions?
Sure. So we, at least I can just speak for our division, we've got people who live North County, some people who live South County, and some who live in the city. I was a person who actually, up until about 6 months ago, lived in East Chula Vista near Otay Ranch, and just moved into the city primarily because of the transportation issues. I think people are really settling from all over. Actually, we have a number of people from East County as well. But I would say the city's workforce is really a good mix of individuals who live, you know, just about every cross-section of the city.
Yeah, and I think people come from everywhere, but I would say in many of those cases, they're people who wish they could live closer and can't.
Yeah, and I like to look at our agency kind of as a microcosm of what goes on. We've been in the same building now for probably 30 years, so that hasn't changed. So a lot of the employees have taken those jobs after they knew where the location of their work was going to be. And we do have a lot of people who live close around North Park and Hillcrest in those areas, but we do have people who commute all the way in from San Marcos or from Escondido. We have people who come across the border from Tijuana. I commute in every day from Alpine. So yeah, there's a lot of people who commute in for work.
Okay, excellent. So this question kind of goes to housing, and maybe we could start with Ryan on this one. This question is about the increase in rent. It says it is accelerating faster than the rate of pay. Is there any plans in the near future to correct?
Well, rent is not distinct from the purchase price of homes that we're talking about. I mean, it's a similar supply and demand issue, I think, that we're seeing
more people moving in and wanting rental housing, and we're not adding new units at a pace that's going to keep the price consistent. So I don't know that this is, there are particular parts of that market where you have some government interventions that are designed to keep things affordable and whatnot, but a large part of rent is simply, I think, just this challenge of not enough units and too many people who want them, and that's going to drive the price up. And that's, so it's just another place that we see the same, and we're not building single-family homes, and so we're seeing the price of single-family homes, steadily outpacing inflation. It's the same story on the multifamily side.
So I wonder about a solution I keep hearing, and just to let everyone know, in the background of my reporting process, there's like a conflicting theory going on with a lot of people I talk to regarding housing. And what I've been hearing, like Todd Gloria, he's going to be running for mayor, but in the assembly, he had proposed some sort of thing to sort of force the development of like mid-level housing. So sort of the middle market, somehow we can give incentives to build this middle market housing. But I think someone mentioned him before, my boss, Jeff Light, Chris Thornburg. He's an economist at Beacon Economics in LA. And his whole theory, and he provided me research to sort of back it up, is that, trying to force the market to build some mid-level housing will never work, because this is what he says, not me, I don't know. But that basically if you don't build these really big, expensive houses, then those rich people that want that kind of thing are just going to move into an area that might be a little bit less expensive, buy a cheaper house that could have gone to a working class family, and just throw like $200,000 into it to make it more expensive. And he had actually provided me a study that they did in San Francisco, where they were able to look at the amount of spending put into older homes, essentially by very affluent people. So I'm wondering, maybe, I think, Stephen, you had mentioned it. What do you think about this? So I kind of have like, usually economists are sort of lockstep with each other, but they both seem to be having this kind of fight back and forth whether or not somehow forcing middle-level housing will do any good. So wondering what you think, Stephen.
Well, I think you're starting to see in North Park, in South Park, where that same thing has started to happen, where people have basically figured out that's a very desirable place to live, and there's a place where they can go in and buy a house at a reduced price and turn into the dream home, and I guess it's fortunate or unfortunate, I don't know how you want to describe it, but people willing to pour in ungodly amount of money into a home, which really distorts the marketplace. So I think that can happen anywhere. I'm not convinced that you can't create some moderate rate housing. And again, maybe it's a concept of mixed income, a different variation of mixed income housing, where you've got wealthy people living in a house with someone that makes $300K a year that's living in a complex with someone that makes $100K a year. There may be a way to create incentives to make that kind of model work, because it certainly has worked in New York and Chicago. So I'm optimistic that you can create something for the moderate rate.
The thing I always hear from the developer side of this about do you keep building $1.2 million homes? Why is that the thing you keep concentrating on? They typically will say that, between land costs, construction costs, and regulatory compliance costs, that's the only house where I actually can earn any sort of profit building it. Anything lower price than that, the fixed cost associated with all that stuff just doesn't pencil out. And to me, that's the word force makes economists very nervous when you just say, we shall build this many homes of this, it's more what we need to do, I think, is bridge that gap of, if this is the kind of housing we as a community have decided that we want to have, and the developers are saying, I can't, as an individual private business, make a profit building that kind of home, that's the trick we have to solve. And whether that's financial incentives, tax breaks, actual money from the government directed specifically towards that purpose. But I think simply just saying, I want this kind of house and you're going to build it, that's just doomed to fail from the get-go. And I think that's kind of underlying a little bit of Chris's point in your discussions with him as well.
One thing, I think a lot of, obviously, without getting into like a NIMBY conversation around housing, not in my backyard, yes, in my backyard. A I think there's a disconnect with people attributing the housing demand in San Diego with people who are coming to San Diego from outside of the region, which we certainly do have an influx of people coming to San Diego, but we are not making enough homes for our kids, our families. And so I think until San Diegans as a whole recognize the fact that the people who have bought homes in the 50s, the 60s, and the 70s, and now have kids who are in their late 20s, 30s, and 40s who can't buy homes, that those are the people who are being impacted by the lack of development, the conversation's not going to change in a meaningful way. But it's not someone moving in from some other place that's driving our housing crisis. It's our own population growing and our own lack of a willingness to think creatively about that solution across a variety of different both policy and development.
Yeah, just let me follow up on that. It's interesting because I've seen a lot of developers and housing analysts use that sort of argument at city council meetings or at planning boards that I've been at, this idea that if I just appeal to that person in that neighborhood to say that their grandson or their granddaughter won't be able to live here and their sons are going to have to leave. And I've seen it in earnest going on for 3 years, and it doesn't seem to make any difference. And I've been in the audience at different projects where they get up and say that, and then just 90 people show up from the community and it gets voted down. So I guess where do we go from there? Is this one of the things I might hear a lot is like, well, we just need the state to step in and do it. But if they've done enough. I don't know. Anything, Ray, you got anything on that one?
No, I don't know that any government agency stepping in to try to fix this problem is going to fix it. But what you said is really very true. The mayor of San Marcos, I talked to him a couple months ago. City council wanted to allow housing to be built. The developer came and said, we want to build these units, and the community comes in droves and says, you can't build those units. So as long as you have the people who are the citizens saying, you can't build it in my backyard, then nothing's going to get built. I showed one graph where we were short by 56,000 housing units just because of what we're not building enough to keep up with the natural increase. There's another over 50,000 units that are off the market because of they're being used as Airbnbs or they're second homes. 25% of Coronado is vacant because they're second homes to people. So these are housing units, but citizens can't live in them. So there really is a huge pent-up demand for additional housing units, if you want the market forces to take care of this, then we have to find a way where we can add 100,000 units and bring the vacancy rates up to around 4 to 5%, where you can actually have people moving from one house to another. That would help moderate the prices, and it would help people who want to move out, start families, be able to live on their own. So, that's the solution to the problem. But it really has to be, it's an attitudinal change of the people who are currently living in San Diego, because if they won't allow building to occur around what makes sense, like a trolley stop, then where are we going to put the houses? So.
Well, the last thing I just wanted to add is that one thing that we will watch this year that we're hopeful for is the Opportunity Zone Fund. And so that's obviously a tax credit for really related to capital gains. And from what we hear from investors is that they are targeting families that make between $80,000 and $120,000, mainly because those kind of financial housing projects can generate a return for investors. And you add that to the capital gains reduction they get, that it actually turns out to a really interesting investment pool. And so we know that there are a number of funds that are being raised across the country, and we're hoping that it ends up being a mini low-income housing tax credit, a product that actually is more targeted toward the moderate income category.
Okay, yeah, definitely be watching that. Okay, so maybe we can go with Sarah here, and then if anybody else wants to jump in. This question says, can we talk about underemployment? Qualified workers taking opportunities below their level. Is this measured? How has it changed over time?
We can talk about it, but not with the data we wish we had. The underemployment rate is only measured to the state level. So, and we call that the U3 unemployment rate, or U6. Did I just mix them up? Yeah, sorry, the U6 unemployment. U3 is the one we typically measure. But so we know at the state level what that is, but locally we can only estimate it, which I haven't really done. I don't know if you guys have. But we know from experience and from the people that we work with, locally that it is something that they experience. There are many people who are dissatisfied with the amount of work they have or the number of hours. And of course, there are forces on that beyond just demand. Part of it is also regulatory requirements. There are people who don't want to give more than part-time hours because of the cost, or not even that they don't want to. That's sort of vilifying more than it needs to be. I think employers generally want to do what's in the best interest of their employees, but sometimes they don't know how to make it work financially, so that they don't have to pay benefits if someone is not full-time.
All right. Okay. This person wants to know, and this kind of goes back to our question about people commuting a far away. It's something I didn't really think about either. Are any thoughts on creating work hub zones where commuters can work remotely in their communities in a shared workspace to help them with the commute challenge? Are you familiar at all with that, Sarah? Is there work hub zones or?
I know there's a lot of shared workspaces that exist and are continuing to open. Can you repeat what we want to know about them?
Any thoughts on creating more work hub zones?
Do I have thoughts on that? Jesse, I think you have thoughts on that.
That's an interesting question, because it really is it's a behavioral change for businesses in the way that they think about how people need to work. And so when you look at the generation that is dominant in the workforce right now, for instance, the baby boomers and the early millennials, the early Gen Xers, what you're really looking at are people who grew up before the smartphone, for instance, and a meeting is required to make a decision. And so what ends up happening is you got to put the people in a room. When we take a look at like the 52 and the traffic that exists on it, there's about 100,000 people who go across that road a day. 80,000 of them are commuting to Sorrento Valley from East County. East County is looking at trying to put in around Gillespie Field. They'd love to put an employment center over there. And if there was remote, work sites for places like Qualcomm and some of the other high tech that is now in Sorrento Valley, they put them in East County, you could probably reduce the commute. But again, this is a behavioral thing that, well, you have to come into the office to have this meeting. I think that a lot of this is going to be taken care of possibly by technology and the changes as the millennials enter the workforce and the younger kids who are growing up online. I mean, you don't need to even see anybody anymore, because basically if you're in the chat group, then you're part of the in group, and if you're not, then that's a problem. But they can actually get work done that way. I know this because my daughter will sit crying on her bed because she get kicked out of some chat room. I'm like, who cares? Go outside and play, right? It's like, what is outside,
Here's
right?
a stick.
Exactly. So, but the thing is that I think that it's how you work and being able to trust your workers that they're actually getting work done when they're not on site is in a lot of ways going to help that happen in the future. And I think that's as us old people die out, that'll naturally occur.
Yeah, and I think there's a company not far from here called Cloudbeds, and they've got almost 100 employees, but almost all of them are remote all around the world. And they've created a company culture where, like, even within the office, because so much of their employment base is not actually they're headquartered here in San Diego, and they've got about 25 employees in their headquarters location, but the vast majority of them are globally deployed. But they'll do meetings in their office where people will not come face-to-face, so they continue to build that culture of communicating virtually, even when that person who's also in that virtual chat with an employee who might be based in Brazil is an office over from you. So there are companies who are making those moves, but I think they tend to be concentrated in technology sectors where already, depending on where that employment or that person, what their industry is, like there's some, especially if you're in manufacturing, building 5 manufacturing plants is not going to be cost-effective for you. So there are only going to be certain industries that can take advantage of that trend. But the other thing I'll point out, WeWork, which is part of kind of a global co-working kind of movement, is the largest landowner in London. And so there are trends in that kind of workforce evolution, and there are companies, major companies like Deloitte and others, who instead of investing in their own buildings anymore, are buying out multiple floors from companies like WeWork, who are investing a lot of money to make these places really attractive, especially for millennial workforce and younger, letting them invest in figuring out how to build that space and make it creative, renting that out for a couple of years, moving on to a new building in 2 years when they change their strategy, and not have to worry about the overhead cost of owning and managing their own building. So I think you are going to see more companies adopting that for certain divisions and certain types of their workforce, and that potentially does present an opportunity.
Fantastic. this ends the Q&A portion. Definitely really appreciate all of our people coming out today, our panelists, very intelligent, and I think they're doing it for free too. So actually, I don't know that. I shouldn't have said that. But I just, before everybody gets up, I just really want to thank our steering committee here, which is Liz Harmon, Edith Zamora, Michelle Maulin, Joshua Ramirez, Giang Myers, Wilda Wong, Desiree Roten, Stephanie Michelle, Eric Morrison-Smith, Laura Kahn, and then, of course, everybody that coordinated this event at the University of San Diego. I get to stand up here, but they did all the hard work, and then also the County of San Diego and Workforce Partnership. So thank you so much for coming out.